here in New York. Romaine Bostick alongside Katie Greifeld, kicking you off to the close here on this Tuesday afternoon. Some wide-ranging comments, Katie, by Ken Griffin today here, kind of hitting a lot of the notes that we've heard from before, but some interesting criticism here of the Fed and its credibility if it starts to cut rates too soon. Some interesting criticism of Gary Gensler and some of the proposals that he has to regulate the industry.
Some criticism, too, for former President Donald Trump about the fact that we haven't seen him on the debate stage, but a lot of praise for, of course, presidential candidate Nikki Haley. A really wide-ranging conversation. A
wide-ranging conversation that our very own Emma Palmer was sitting in and listening in on. Our Bloomberg hedge fund reporter joining us right here in Studio 2 to talk a little bit more about what Griffin said. And I do want to start off first with some of his comments about the Fed, because I think that's at the top of everyone's mind, given the CPI report this morning, and given that there are a lot of bets in this market right now that the Fed will start cutting rates as soon as next year, maybe as soon as the second quarter of next year. He made it clear in his comments he thinks that would be too soon.
Yeah, he said that if the Fed cuts rates too soon, the Fed risks losing its credibility. He said that the Fed really needs to have the message that they're going to put the inflation genie back in its bottle, that needs to be their priority, and this 2% inflation target really needs to be the main point of attention here.
So some harsh words potentially for the Fed, some harsh words for Gary Gensler. Griffin said that Gensler is seeking solutions for imagined problems. Just to unpack that for us.
Yes, he said that that regulators right now are looking at problems that aren't really there. He said that he's never really seen, the worry about the basis trade right now isn't really a thing. It's trivial, and this builds upon some criticism he's had before about and been vocal about before with Gary Gensler and some of the regulatory changes and scrutiny, especially around things like the basis trade. So he just continuing his stance that there really is nothing to worry about there.
All right, Emma, appreciate you listening along with us. Our thanks to Bloomberg's Emma Palmer. And of course, that conversation with Ken Griffin came hours after that CPI print, Romaine, that I think caught a lot of people by surprise. Most of the commentary that I read going into the print was maybe we were going to see an upside surprise. I think we saw the opposite.
Yeah, we saw the opposite. In fact, it was probably one of the widest gaps that we've seen in both in terms of expectations, but also just on a month-to-month basis change here. I believe that was the biggest decline that we have seen right now, at least in the headline number, in more than a year here. And it really adds to a lot more of that narrative here that, A, the disinflationary trend, yes, indeed, has continued, despite the fact that we had a little bit of a hiccup the last 2 months. But this idea that the longer-term trend is basically what the Fed has wanted to see, and that's going to continue into next year, enough so that we're now talking about rate cuts again.
We are indeed, and you can see that
And
pricing.
by we, I don't mean me, but I mean like other people who are maybe a little bit
we
more
are talking about what they're talking about.
Okay, that's fair.
Yeah, and you are seeing that pricing come through in the bond market. But I'm thrilled to say we have the perfect guest to unpack this with Cathie Wood joining us now, CEO and CIO of Ark Invest. And Cathie, obviously, CPI, you saw it cool across the board in October, both on headline and on core. And to say the least, the market reaction has been pretty swift. Curious to hear your thoughts, though. When you think about what this means for the Fed, is it safe to say that we've seen the last Fed rate hike of this cycle?
First of all, I'll say I agree with almost everything Ken Griffin just said, except his comments about the Fed. For some time now, we've been saying that the Fed has overdone it and that the greater risk here is deflation. Yes, the CPI did not surprise us at all, although there were rumors that revisions would take it higher than many people thought. And so we believe we're beginning to see deflationary trends in many more sectors now. It started with commodities. Now we're seeing airline prices coming down, auto prices coming down, and we're seeing staples prices. They have been sticky, but what's happened to staples volumes? They have gone down. That's not how you run manufacturing plants. So we think that they will be forced into cutting prices as well. You heard Home Depot today, negative 3.8% comp store sales here in the United States. And if you look at the S&P 500, I think a third of all companies in the S&P 500 are reporting negative revenue growth. What we have characterized the last 2 years as a rolling recession. Some measures of housing are down 40%. That's a recession. How autos, 15 million units in the U.S., that's kind of punk. It's recession-like. And we're seeing these volume declines in staples.
Right.
You've got consumers pulling back. So I think the Fed's overdone it. I think we're going to see a lot more deflation going forward. We are going to hit that 2 handle, and we will go below it, and would not be surprised to see CPI inflation negative at some point next year.
Well, Cathie, if that materializes, let's talk about how the Fed responds, because as we've been talking about, you have seen traders really pull forward their pricing for rate cuts next year. Add to that, what do you think this translates to in terms of magnitude of rate cuts that the Fed will have to deliver?
Well, if we're right and they've gone way too far, they'll have to cut fairly significantly. I tweeted, although I don't know if I use the word tweet anymore, on X, I put a chart which showed the ratio of metals prices to gold prices and charted it against long-term interest rates. We've never seen this big of a gap. The metals to gold price indicator is saying deflation is the risk. It's down near the low end of a range. And the long-term Treasury yield is way, way above where it should be. In fact, this metric would suggest, if you just eyeballed the chart, and it's not perfect, 2% would be the right level of rates. So I actually said that in my last In the Know YouTube video. 2% rates, that was the reason. Just looking at price signals that the Fed does not seem to be paying attention to.
I'm curious, Cathie, about that. I mean, based on that, and I remember seeing that chart, and I've looked at that same ratio. I mean, that would imply that basically where we're at right now, in the mid to high 4s, closer to 5%, that we need to get back down somewhere around 2% here. And I can't really see how that happens without either a significant economic downturn or just what would just be an unprecedented pivot by the Fed.
I think we're in a rolling recession, and it will continue. I think consumers are basically saying no mas when it comes to pricing. We're seeing that in volume numbers. Mm-hmm. And so if companies can no longer get pricing, what's going to happen? Their margins, which have held up, are going to get crushed. And we do think that's the case. Now, they've held on to employees who were very difficult to get during the rebound from COVID, reluctant to let them go because it was such a struggle to bring them on. I think that's going to change. They're going to be responding to margin pressures. And we do think you're going to see more unemployment during the next 3, 6, 9 months in an election year. Yeah. So it will really get a lot of attention.
Well, I'm curious as to what this then means for financial markets. I mean, let's just kind of go with this, that this is the hypothetical that the Fed remains behind the curve. They don't react enough, and the economic consequences are severe, even if it's not a recession, but they are severe enough that it significantly limits consumer spending, and for that matter, even business spending. How does that sort of factor in, I guess, to the growth story with a lot of the stocks that I think so many people have embraced this year, based on this idea that there was a longer-term structural story in a lot of those names? How does that change, if at all?
Well, I mean, I don't know if you're referring to our ilk of stock. We're very focused on innovation platforms that are evolving today, and they're not immune from recession, but they are recession resistant, and they actually gain more traction during tough times because they're better, cheaper, faster, more productive, more creative in terms of new products and services. So they gain more traction in tough times and then come out of a period like this flying. That has been the history. In terms of strategies like ours, that I think we've paid our dues. 21 and 22. 21, our strategies were down just at the idea that interest rates might move up. And then in 22, they were crushed because interest rates moved up 22-fold, more than they ever have in history, over little more than a year's time. And so we've paid our dues. I think the beginning of this year, the market started to say, okay, inflation's coming down. It peaked at 9. We're coming down, and we were coming down. We had a great year through July, and a little bit of a setback as inflation fears picked up again. But I think today's report is very important in terms of look through there and see the price declines. You'll see a number of them. And this idea that deflation is spreading, I think, is going to gain more currency during the next few months.
And Cathie, to that point, you take a look at the Ark Innovation ETF, currently up about 33% or so year to date. I want to switch gears here and talk about what everyone wants to hear about, and that is a potential U.S. spot Bitcoin ETF. I know that you can't say too much about an active filing, but when you think about the process thus far and you think about potential timelines here, do you think that we're going to see spot Bitcoin approval, spot Bitcoin ETF approval in the U.S. by year end, or is that a 2024 possibility?
Well, we're looking at a change in the SEC's behavior, first and foremost. You know, when we put in our first few filings, they were rejected really out of hand. We got no questions. We had no interaction. That changed this year. And the SEC asked some really good questions. We know that the SEC, certainly on the research staff, is highly sophisticated in terms of understanding what could go right and what could go wrong. The questions were great. We answered those questions. So that was a change in behavior, and we believe other firms had the same experience. That was a change. And our deadline, and we're the first in line, I would say, is January 10th. At that point, this is the final deadline. Either they approve or they deny. What we think could happen, and I'll give one caveat in a moment, is that by that time they will approve, but not just one. It will be a number of us because they don't want to pick winners. So the caveat here is there is Grayscale is out there, and there was some thought that the SEC would allow Grayscale to convert from a grant or trust for Bitcoin to an ETF. Now, I don't know if that was Grayscale's thought or conventional wisdom. There are rumblings that that might not be the case. Grayscale is public in saying that it will sue the SEC again if it is denied. So I don't know if that would hold the timeline up. But if that were not to happen, I think we're getting close.
And so, Cathie, just to make sure I'm understanding that, so if Grayscale were to come out and sue the SEC again, that could actually maybe delay the process before that January 10th potential final deadline.
It may or it may not. You know, the SEC may feel it is standing its ground, and these are the processes and procedures, and Grayscale needs to hew to them and just keep going, or it may not. It is an uncertainty out there, and it's anyone's guess.
And Cathie, talking about the ETF industry, in September, the news came about that Ark was buying Rise ETFs. Now, that is a European-based ETF business. And I've been wanting to ask you this basically since I wrote up that story. Why buy another asset manager to establish a European presence versus just going out and launching Ark ETFs organically? Well,
a couple of things. First of all, the reason we did it was 25% of our subscriber base, now we give our research away, but 25% of the readers are from Europe. We can see that. And the number one question, probably for the last 5 or 6 years, is why can't you issue a UCITS ETF in Europe? And so we started studying that as a strategic option. And we realized Europe is a very complicated market. There is no way an American company, even a well-known brand in our space, can go into Europe and understand all the cultural nuances, all of the regulatory nuances, especially because sustainability in Europe is so important, and they have Article 9, Article 8, they're categories, and many companies that declared themselves Article 9. So, they were at the top of the heap in terms of sustainability. 70% of them had to downgrade to Article 8. So there are regulatory nuances. This company, Rise, now Ark Europe, same DNA as Ark, very thematic in their focus, very futures-oriented. They self-index their funds, so these are index strategies, but they know their stocks. Unlike another index manager, very often they won't know what's in the portfolio, or if they do know, they won't know the management teams. This one is different and very similar DNA, and did very well through the sustainability downgrades. Not one of their funds was downgraded in that way.
All right, Cathie, always enjoy speaking to you. Really appreciate your time today. That is Cathie Wood, of course, the CEO, co-founder, CIO of Ark Invest. And it's really interesting to hear her reaction to this print. A lot of people have been saying, this is validation for the Fed. This is proof that things are working. But interesting to hear Cathie say, no, maybe this is proof that they've gone too far. Yeah,
well, I mean, that's the argument, but I guess it depends on why you think we've gone from a headline rate of 9+% down to what is effectively around 3% here. If you believe that is because of the heavy lifting that the Fed did, then of course that means Cathie is wrong. But if you believe that a lot of that was in effect just some of the structural issues from the pandemic and some of those transitory effects that we all dismissed finally sort of reversing themselves on their own, something I think some Fed members have kind of alluded to, including Kashkari and Bostick, then I think she is right, at least to a certain extent on that. And it makes you wonder about the lagged effects of that 5+ percentage points and whether we've actually seen the true effect of it.
Well, we'll find out. I believe she gave the prediction that CPI will be negative in 2024. So we can check back in about a year.
Yeah, I mean, I always hate those calls because I mean, they're going to be wrong. Not because she's wrong, but just because it's so far out and so much can change.
Anything could happen.
And we know that the conditions that she uses today to make that prediction, there are so many things that are going to happen in our world over the next few months that we don't even know, the unknowns, if you will, that are going to change that prediction. But nevertheless, very smart. I was a little curious, though. We didn't get to ask her about Florida. I mean, because she's got a huge presence. I mean, I know she's not quite there in the little Tony Brickell Bay where Ken Griffin is walking around in his Gucci loafers, but you go over to St. Pete and town. I was down there earlier this year, and I walked by the facility that she's building for her, Ark Empire here. I mean, that place is booming down there. So we got to get her on to talk about that a little bit more as well. Meanwhile, we do want to shift gears here to another big story, and that has been, well, the summer of strikes, which turned into the fall of strikes, and at least one of those big strikes, at least for right now, appears to be over. SAG-AFTRA actors now starting what is going to be a 3-week-long voting process to ratify that tentative agreement that was struck last week with the Hollywood studios. Pleased to say, joining us right now is the president of that SAG-AFTRA union, Fran Drescher, as well as the chief negotiator in those negotiations, Duncan, Crabtree-Ireland. Thanks for both of you taking time to be here. I guess congratulations are in order. I think a lot of people thought this was going to drag on a lot longer here. And I'm going to start with you, Duncan, just because I know that you were really kind of at the table for this. And I am curious as to whether you yourself were surprised that this got done when it did.
Well, Fran and I were just, partners in this whole process. And I will say, to me, the duration of the strike was longer than I had ever thought it would be. We reached a deal on the very last day of the strike, of course, and even in the last hours with one of the most crucial pieces of the whole negotiation. So from my point of view, we should have been able to get this done with a shorter strike or with no strike. But I am glad that we finally did reach this deal, and I think our members are going to be very, very pleased with the results of the efforts that they've all put in to find this fair deal.
I'm curious, Fran, if you can address at least one of the main criticisms that at least that we know publicly, which has been that while there were a lot of gains on pay and a lot of gains on some of the other issues, there were some people that felt that some of the concessions made with regards to artificial intelligence, as well as just the way that these streaming companies compensate actors and for hit shows, that didn't necessarily live up to some of the original asks.
I think that there are some people that are not really savvy about negotiations. And when they find that there might be one pet issue of theirs, they're willing to throw the baby out with the bathwater. When the truth is that blank page after blank page after blank page has been filled with new language that never existed before. That new stream of revenue on the streaming platform has been established that never existed before. And I sincerely doubt that the AMPTP ever intended to give us. And pattern has been broken with the other unions. So we're actually getting more minimum wage than they were able to get. And I think that AI, which is a totally new area of discussion for our contract, has been fully entrenched, and we really did not agree to it until the last piece was in place. A lot of people that are not attorneys, are not as experienced with negotiations as Duncan Crabtree-Ireland, may be trying to shoot holes into it. For what reason, I don't know, because everything has been very finely vetted so that our members are as protected as they possibly can be at this time, including we'll be meeting twice a year with the AMPTP to keep our fingers on the pulse of this new technology.
And just with regard, just to follow up on that, Fran, with regards to the new technology, I mean, can an actor, particularly a newer actor, one who doesn't necessarily have the big name recognition and clout, when they're coming into this industry and they're getting these gigs, can they have some confidence that if their likeness is used in some sort of AI way, where basically they're doubled up or tripled up into other types of in other types of forms here, that the compensation for that they're receiving either upfront or residuals down the road will be commensurate with that use?
Not before this contract, but now they must get they must get consent, and in many cases they have to get compensation. And you know, it's just a whole new frontier. So I think Duncan can probably speak to this more eloquently than I can.
Well, Duncan, yeah, go on.
Sorry, go ahead.
No,
I was just going to say, to that point, you know, informed consent was one of the first things that we fought for and throughout this entire negotiation, because having the right to say yes or no also means you have the right to negotiate for fair compensation. And we did establish minimums for a lot of uses in the AI space of digital replicas and so forth. But the number one thing that is a through line in this contract is the right of performers to give or withhold consent, informed consent about what's actually going to be done with any kind of digital replica. And that's something I think that Fran and I both on our negotiating committee and our board are very proud of, because that is an unprecedented limitation on the use of this technology.
And Duncan, I mean, adding it all together, you take a look at the final vote. It was, what, 86% voting in favor of this deal. That remaining 14%, though, you think about some of these issues we're talking about. Is that a concern for you, especially when we think about where we're going to be in 3 years?
Well, you know, this is a democracy. This union's a democracy. People have their own opinions. Fran referenced before, some people have certain specific issues they're very focused on. But I think the 86% vote reflects the wide consensus amongst our board. The unanimous vote out of our negotiating committee reflects the fact that this deal is the very best deal that could be negotiated at this time, even with the use of all the leverage that we generated from having a strike for 118 days. So I feel confident that our members will respond positively to that sign of real consensus around this deal.
Also, a lot of people that know that they're not going to actually ruin the passing of what is really a seminal contract decide to vote on principle so that the people that they represent, the community that they represent, can see that they're taking a kind of political stand on it. And I'm sure that you see that all the time in Congress as well.
And Fran, I want to talk a little bit more about the AMPTP. Of course, we're talking about AI, specifically when it comes to the streamers. Do you think, though, that it should be broken up, given how different the business model is for the Hollywood studios versus some of these streamers?
Well, I'm not sure I understand the question, because the streaming platform, some of the AMPTP members are in streaming. Some they're completely entrenched in streaming. Some it's kind of an offshoot of their big conglomerate. And then there are AMPTP members that are not in streaming at all. So that always makes it complicated when you're negotiating a deal like this. But it was very important that with the streaming platforms, that a new form of compensation be carved for the people that are on that platform, because the old residual model of contract structure really did not accommodate the unique quality of what streaming presented. And I identified that, and Duncan and I discussed it at length, and that was when we made that a centerpiece of the negotiation.
Yeah. Well, I mean, now that this is almost behind you with regards to the actors' strike itself, I know there's still some unresolved issues when it comes to video game voice actors, as well as sort of the stage, the folks behind the scenes on a lot of these theatrical productions. Where do we stand right now in addressing those talks?
You know, the video game negotiations are going on today, tomorrow, and Thursday. In fact, our committee is meeting right on the other side of that wall there. And we are just as committed to achieving the kind of results that our members need as far as AI, as far as minimums in the video game contracts as we were in TV theatrical. And we will stand strong there. I hope that the video game companies will see what's happened in the TV theatrical space and will make a deal without the need for us to pull the trigger on a strike.
All right. I think we're out of time, folks. Really appreciate both of you taking time for us. Duncan Crabtree-Ireland, the chief negotiator and national executive director over at SAG-AFTRA, and our thanks as well to Fran Drescher, of course, who heads that union group. Stick with us. We'll be back in a moment. This is The Close on Bloomberg. This is the countdown to the close, almost 2:30 here in New York, and keeping an eye on some extreme moves in markets right now, including in the equity markets, including in the fixed income markets, and FX as well. The dollar spot index right now having its worst day in more than a year, and that's having an outsized impact on commodities. Abigail Doolittle standing by right now with our commodities close.
It certainly is, Romaine, and especially for metals. Take a look at silver and iron. And in fact, if you were to use the GLCO function in the Bloomberg terminal, which is basically an overview of what commodities are doing at a moment in time, all of the metals are higher, having to do really with that dollar that's down more than 1%. Metals in particular are sensitive. And then also with the market's perception right now that the inflation story is done and gone, that's also seeming to help out some of the metals, especially the industrial. And also there's some optimism around China that's helping out iron ore. Take a look at natural gas. Yesterday it had been higher on cooler weather forecasts. Today, not so much. We have some fickle behavior quite often in some of these commodities, and that seems to be the case there. Coffee, on the other hand, Romaine, coffee traders not hearing about how much I drink coffee, down for yet another day in a row, down for a third day.
All right, a nice wrap up there by Abigail Doolittle. Of course, a day where we keep an eye on price pressures across the board. The October CPI print here in the U.S. coming out this morning and showing an unexpected slowdown in inflation, and that's bolstered bets that the Fed's aggressive hiking cycle is now over.
We certainly see the early signs of a slowdown.
We're sort of gradually sliding into a softish landing.
Potential for a soft landing is still there.
Across the board, there's disinflation in the U.S. economy, and we're heading back to 2%.
We're probably past the point now, at least with conditions remaining as they are, for the Fed to hike again.
The Fed is done.
The Fed probably is done.
That period of pause has now begun.
This is a fantastic environment where they're probably not going to have to do anything else.
Next year, they will begin to open the window to lower rates.
If they are confident that things are really going to slow down, then they could start to cut rates, maybe summer or so of next year.
All right, some of the best and brightest people on Wall Street reacting to today's CPI report. Let's get another voice on this show right now. Victoria Fernandez joining us, Chief Market Strategist over at Crossmark Global Investments. And Victoria, I mean, look, this was the most meaningful month-to-month drop that we've had in inflation, I think, this entire cycle now. And I guess you can look the gift horse in the mouse if you want to, but you're not going to find a whole lot bad in this report, at least when it comes to that disinflationary trend. What did you make of it?
Yeah, so you're right. We need to accept the good that we see in this report. But I think in that montage, someone said there's the potential for a soft landing now. And I think that's what we need to look at. I don't think we can say the Fed is 100% done. I can say they're much closer to done than they were before this report. You can look at futures and see that they're not pricing in any more hikes. But Romaine, let's also look and see. Headline was 3.2%. That's still higher than where we were 5 months ago in June. We've actually gone up since then. So we're not in this completely disinflationary or deflationary environment where we can say everything's great. You look at primary rents, they're up 7.5% year over year. Services number was brought down because hotel prices were down. So there's like, you can give something with one hand and take away with another in this report. I like that the numbers are coming down. I just think we have to be careful, especially when looking at that super core number that the Fed likes to focus on. You're up 4.9% on an annual basis over the last 6 months with that number. So we can accept it, but let's be cautious as well.
Something I want to bring up too, and it's kind of outside of the report here, and it just kind of gets to this idea of trying to assess this whole idea of a soft landing and just economic conditions overall. Some of the earnings that we've gotten, particularly with some of the consumer-facing companies, seem to suggest that consumer spending, particularly on goods, has materially weakened. And I think that Home Depot report this morning really sort of hit home. This idea here that people are still spending, but not necessarily on the big ticket items anymore here. Now, whether that's a function of whether they can afford it or it's simply because they just don't need those particular items, that's a whole nother debate. But when does that start being a concern for you?
Yeah, I think that's something we have to watch very closely. And you're right, when you look at the Home Depot report, countertops, flooring, all those kinds of things had actually come down. What went up for Home Depot? Decorations went up, paint went up, so some of those smaller projects. So the consumer obviously has been what has supported this economy a little bit, probably just normalizing somewhat. But look, we have Target and TJX tomorrow. We've got Walmart and Macy's on Thursday.
All right, it looks like we're going to have to work on Victoria's connection there.
Yeah.
When she comes back, I hope to ask her about this idea that, you think about what we're hearing from the retailers, you think about the durability of the consumer maybe starting to crack a little bit. But remember, we heard from Powell last week talking about you have to be on alert for inflation head fakes. And then you think about what we got today. Are we just seeing that play out?
Yeah, I don't know. Obviously that's going to be a big topic. And look, this is why the Fed always says, look, we need, what did he else say in that speech, right? We need to see something like 6 months of data to call it a trend here. And remember, we had that earlier this year where it was clearly a straight line down in terms of the disinflationary trend. And then you had those couple months where it kind of spiked up. Now we're back down. How many more months does Jay Powell need to see before he says, okay, that's not a head fake?
Let's ask Victoria Fernandez that. I believe you're back with us, Victoria, and come into this conversation that Romaine and I were just having. We heard from Jerome Powell, last Thursday, saying that it's important not to get misled by an inflation head fake here, that even though we see a few good months of data, that's not necessarily a signal to say that the job is finished. When you think about the numbers that we got this morning, how big is the risk that maybe this is the head fake that he was describing?
Yeah, we had a really outsized reaction this morning to this, and that surprised me a little bit. I thought, yes, we'll have a little bit of positive movement in the markets, but I didn't expect the size move that we got. And I think we have to look back. Look at the 1970s. Powell has talked about this before. They don't want to get to the point where they're done and cutting rates and then therefore actually stroking inflation and having to go back and start hiking rates again. We also have to be conscious of the fact that 2024 is an election year. When you look at 1976, we got these election checks that came out to individuals and it restoked inflation. We've got a lot of stimulus in the pipeline for next year from bills that were passed last year, when you look at the infrastructure bill and the CHIPS bill. So we could have some more inflation come to fruition when we're not really looking for it. And I think that's what Powell's trying to avoid.
Well, with that in mind, Victoria, how are you viewing today's rally? Is this something to fade, or is this broadly the right direction?
Well, I think longer term, it's the right direction. But if we're looking shorter term and we want to be tactical, then I think you go in on these days when we're up significant amounts and you start trimming some of the names that have done well, and you start looking at other areas that you can buy into. Sectors like healthcare is an area that we've been buying some names into, even some of the energy names that have had a pullback. So I would trim on these high days and start looking for other elements to broaden out your portfolio and have that diversification, because I do think we're in, Katie, for quite a bit of volatility over the next few months.
All right, Victoria, really great chatting with you. Great to get your perspective on a huge CPI print this morning. Victoria Fernandez, she is Chief Market Strategist over at Crossmark Global Investments. Meanwhile, we do want to bring you some breaking news. This coming from Coinbase, of course, the cryptocurrency exchange. The company saying that it's investigated elevated error rates across web and mobile, and that customers may have trouble completing buys and sells. You take a look at shares right now, off by about 1.7%. They had been lower on the day already, but moving a little bit lower right now. We're going to continue to keep an eye on that story. But still ahead, Meta. It has more Wall Street bulls than ever before, but not everyone is a believer. Next, we'll talk to one of the few analysts that isn't fully sold on buying the stock. This is The Close on Bloomberg.
Time for a view from the sell side with our top calls, the big movers on the back of analyst recommendations. And we start off with New York Community Bank Corp, getting its only sell rating. This is after Wedbush downgraded the regional bank to underperform. What the analyst there says the stress from higher interest rates in the New York City rental property market could actually lead to more non-performing loans or loan modifications at below market rates. Shares, though, shaking that off, up about 0.8% on the day. Nutrien up next, a double upgrade to overweight from underweight over at Barclays, which switched recommendations on a whole slew of ag, chemical, and fertilizer stocks. The analyst citing more upside to companies with potassium exposure versus some of the competitors that have nitrogen exposure as more the predominant focus of their business. Nutrien shares up about 4% here on the day. And finally, Take-Two Interactive. Deutsche Bank lifting its rating to buy as a lot of excitement really building right now for the video game developers installment of Grand Theft Auto. The analyst expecting positive investor sentiment and market reaction once that trailer for the game is released next month, as anticipated. Shares higher by 3% on the day. And those are some of our top calls. Let's take a look at another big mover on the day and, quite frankly, on the year, and that's Meta. Of the 70 analysts tracked by Bloomberg that cover this stock, at least 62 have buy equivalent ratings, the most since the company went public back in 2012. But there's still a lot of uncertainties out there for a handful of analysts. And joining us now is one of them who's not fully sold on buying into Meta just yet. Mark Zgutowicz joining us, senior analyst over at Benchmark. He has a hold rating on this shares. Just about 6 analysts on the street right now with the hold rating, 2 with the sell. And Mark, I guess I just want to kind of get your general thinking right now behind this stance in light of the big run up that we've seen in the shares this year, which last time I checked, Meta's on pace for its best year ever.
Yeah, it certainly has. And I think, the stock isn't incredibly expensive here, particularly if you look at it on a relative basis to the S&P PE, forward PE. But I think there's some limitations that we see in terms of momentum heading into next year that, keep us on the sidelines here. And I think that's, I can get into the details, but I think the consumer is part of that equation.
Well, let's get into the details here, because I feel like we've gone through these cycles with Meta and Facebook, the previous iteration of this company, where everyone sort of expected, okay, this is it. They finally sort of peaked, and we're now going to start to see that drop in users, that drop in ad spending. But they always seem to find a way to, I guess, to kind of re-up and find, I guess, some new generation of folks to sort of latch on to one of their brands.
Yeah, and I think it's less about user growth. I think it's monetizing existing engagement. But I think, what we follow is, given, roughly 75% of Meta's revenues come from small businesses, we pay a lot of attention to direct-to-consumer company spend on Meta, and specifically Facebook. And just more recently, I'd say over the last couple months, we've seen ROAS decline year over year on the platform. And that's, a flag for us in the sense that if the last time we actually saw year-over-year declines in ROAS on the same database was just after Apple introduced the iOS 14.5 IDFA restrictions. So that's something we're paying close attention to. And really what's driving that is new customer growth. And I don't know that this is necessarily Facebook specific. I think this potentially is more economic, we need to pay attention to. But really just having a difficult time driving new customer conversion on the platform. And if you can't drive new customer conversion on Facebook, you're going to have a tough time doing that really anywhere. So that's one topic that I think is worth paying attention to. The other is just the amount of growth that they see from China-based advertisers, and specifically like Temu and Shine, in terms of their spending in the U.S. and other parts of the world through Facebook. If you look at their growth year to date, which has been a little over 13%. Roughly, we estimate about 4 to 5 points of that growth has come strictly from those China-based advertisers, and we've seen that that momentum start the first quarter of the year and continue through the remainder of the year. So that sets up, I think, some tough compares into a tough macro next year.
Well, Mark, I want to get your thoughts on some news that actually came from last week, that you have Amazon basically testing out a feature that would let shoppers basically buy Amazon products directly from Instagram, from Facebook, without having to leave the app. If something like that came to fruition, I mean, what would that mean for Meta in terms of being attractive and maybe more effective for these advertisers?
It's a great question, Katie. I think that's a double-edged sword whenever you partner with Amazon, because Amazon, whenever they partner with somebody, is always the winner in the end. So it's not unique to Facebook. We've seen it with Pinterest, and Snapchat was recently announced as well, where Amazon will be essentially, offering its ad units. I think that speaks to the necessity for all these platforms to have really provide more utility to customers by having every product that they could possibly be interested in on their platform. But on the other end of that, what is Amazon collecting from that? They're collecting data on the user. And what does Amazon ultimately want? Amazon wants everybody to go to Amazon.com first. So I think while in the near term it presents some incremental economics for Meta as well as these other social platforms, I think longer term the risk is that you take that engagement off of Facebook and these other platforms and move it to Amazon Direct.
All right, Mark, great to catch up with you. Mark Zgutowicz over at Benchmark, a closer look here at Meta shares and, quite frankly, its future and its valuation. And speaking of tech titans, a number of executives from Elon Musk to Satya Nadella are in San Francisco this week as part of the Asia-Pacific Economic Cooperation Convention, APEC. The hope is to woo Chinese President Xi Jinping and other leaders here. And we've seen this before here, Katie Greifeld. Anytime you get a big leader, particularly from, in this case, the second largest economy in the world, of course, every business leader is lining up to make sure that they get a piece of that pie as well.
And this is a critical time for San Francisco, an important time. I mean, there's been a lot of ink spilled, a lot of words said about San Francisco's demise or decline, whatever you want to call it. So it both has geopolitical consequences, but also very interesting for the future of San Francisco. Yeah,
and I mean, we should point out, I guess, I mean, none of them are really based there, right? I mean, Jane Fraser, Satya and Nadella is away up in Seattle, and then and Elon Musk, I don't know, wherever the heck he is, he's on the moon or Mars or somewhere. But, it gets to the broader question, too, here, that when we talk about what business leaders can get out of China, the big question hasn't so much been, what's the economy like? What's the TAM, the total addressable market? It's whether the regulatory environment and, more importantly, the wins of Xi Jinping are going to squash any sort of efforts that they make.
Yeah, basically, can I get access?
Yeah, can I get access? And is that access going to be yanked away from me at any minute because I, said something?
Some heavy questions.
Heavy questions. Many questions that need to be answered here. We'll try to answer them here on the close as we move closer to those closing bells. But before we get there, we have to check in on the latest sort of mashup going on in Washington right now. A budget deadline here coming up this Friday, and the Speaker of the House, Mike Johnson, he says he has a plan. The stopgap funding bill is right now on the table, expected to be voted on potentially as soon as today. He needs Democratic support, and based on Bloomberg reporting, he might actually have it. We'll discuss after the break. This is Bloomberg. The odds of a U.S. government shutdown may actually be diminishing. The House is preparing to vote later today on a funding plan supported by Speaker of the House Mike Johnson. And that plan, believe it or not, has actually gained support from at least one of the largest caucuses for the opposing Democratic Party. We're also hearing from members in the Senate, including on the Republican side and the Democratic side, saying that they are also on board with this. Bloomberg politics reporter Gregory Cordy joining us right now to talk a little bit more about this. And Gregory, give us a sense here. We know based on at least the procedural vote that we do think is going to take place is going to require 2/3 majority, which means he's got to get a lot of Democrats on board with this here. We've got some encouraging language already out of some key leaders, but is it going to be enough?
Yeah, there was a lot of suspense about this yesterday when we talked because it wasn't entirely clear whether House Speaker Mike Johnson had the votes from within his own Republican caucus to pass this alone without some Democratic votes. There were some Republican hardliners who were objecting to continuing to kick the can down the road with another short-term stopgap spending bill. And so the Speaker needed Democratic votes. The fact that he's put this on the calendar for this afternoon under suspension of the rules means that he needs 2/3 votes, and the only way that he would get 2/3 of the vote in the House is if significant numbers of Democrats came along.
Well, I'm just curious, can you just also square that circle? Because, I mean, let's just be clear. There are a lot of Republicans, at least publicly, that said they're not going to vote for this. So this isn't just the simple math of tally up all the Republicans, add in the number of Democrats to get to 2/3. There's a hole that he's going to have to fill on the Republican side.
Oh, absolutely, yes. He needs some centrist and moderate Republicans. He still has a little bit of a honeymoon with Republicans. He's only been Speaker for 2 or 3 weeks now, who will say, hey, look, I don't, we're hearing from a lot of Republicans, look, I don't understand this play. I don't think it's the right strategic play, but I'm going to support the Speaker in doing what he thinks he needs to do to get us to where we need to be.
And when it comes to the fact that maybe he has won over some Democrats, let's talk about what's not in the bill, because this measure doesn't include emergency aid for Israel, for Ukraine. So it's not like, you know, when it comes to the Democratic Party that they're getting everything that they want here.
Oh, absolutely, and that was part of the original objection that we heard from the White House to this this bill, is that it didn't include those big priorities of Israel and Ukraine. We expected maybe to see a veto threat from the president on this yesterday. That veto threat never came, and that's been the signal that House Democrats have needed to decide that, okay, maybe this is something that we can support. At least it keeps the government open through January or February next year. We can come down to those battles later. It's a very Washington way of dealing with this crisis.
It's a very Washington way that, quite frankly, has been going on for more than a decade, Gregory. To say it's tiring, and I think the American people have kind of exposed it for what it is. I am curious about just the general cooperation, if you will, on Capitol Hill. We know Democrats and Republicans have been at odds, and there's a lot of stories right now saying that there's just so much discord within the Republican Party. The whole story today on Bloomberg about Kevin McCarthy and whether he, punched Tim Burchett in the kidney, and then Marjorie Taylor Greene sort of questioning Darrell Issa's manhood. I mean, these are things that seem to suggest a party that is still fractured. And even if we are able to get over this hump on November 17th, the idea that somehow 3 months later there's going to be enough unity to get something more long term, I'm just not seeing it.
Absolutely. I don't know what more to add to that, what you just said. This is a Republican Party that we've seen the fractures all this year, from the 15 votes that it took to first elect House Speaker Kevin McCarthy in the first place, to the unprecedented and historical vote to depose him as Speaker in the middle of a congressional term, and then all of the chaos it took 3 weeks to find a new House Speaker. We're seeing this Speaker has not been able to change that math. He's not been able to corral all of these hard elbows, literally and figuratively, within his own caucus, and we can expect more of the same, at least through the elections next year.
All right, Gregory, really appreciate your reporting. That is Gregory Cordy. He is Bloomberg politics reporter. Meanwhile, about an hour away from the close, you're looking at a big rally. This is Bloomberg. Just about 3 p.m. here in New York. This is the countdown to the close. Let's get a view from the top.
I'm Romaine Bostick.
And I'm Katie Greifeld.
Stocks having a pretty strong rally here. Katie Greifeld and S&P right now having its best day, basically going back to the start of the year. I was looking at the Russell 2000, which for some reason is up 5% on the day. That's its best day since November of last year.
I was reflecting on what we were talking about 24 hours ago. I think I made the stellar point that who knows if the numbers we get at 8:30 a.m. are going to clarify anything. Well, maybe I'm eating crow a little bit today because it seems like the market has really coalesced around the narrative that we saw the last Fed hike of this cycle. We saw that last in the summer, and looking forward, maybe the Fed doesn't have as much work to do.
Yeah, maybe a little bit of a tempering of some of the expectations, though, because, of course, Jay Powell himself has made it clear here that one report does not equal a trend. And I even think he even sort of put something like, you need to kind of want to see like 6 of these things strung together before you get that trend here. And maybe if they can flip up the board here, too, because we talk about the outsized moves they're seeing in equities, outsized moves they're seeing in the dollar. In fact, the dollar down, having its worst day that we've seen pretty much all year long as well. And then, of course, what's happening in the yield space right now, which is driving a lot of this here. There's your 2-year yield. Kind of hard to see on the chart here, but basically you're looking at the biggest drop that we've had in several months.
Yeah, and of course, I'm sure we're going to be discussing whether or not that's justified necessarily, but we move from the bond market and the drama that we're seeing there. Let's talk about some of the individual movers today, because there's plenty of equity market stories out there. I want to start with Snapchat. We were talking a little bit earlier about Meta, that feature that they're testing with Amazon, that you could shop Amazon ads directly on the app. Snap actually theoretically looking at the same sort of thing, this coming from reporting by The Information, that you wouldn't have to leave the app. You could shop directly on these Amazon ads. The thinking is that maybe this will make these social media platforms more attractive to advertisers. That seems to be the logic.
Will that make it more attractive to users? Because anytime I hear like more ads, a more efficient way to deliver me ads, I'm just kind of,
I know.
It's just like, just kill me now.
Yeah, I know. In terms of engagement, it's maybe a double-edged sword there. But let's also talk about...
You're a social media person.
I am. And I'm embarrassed to say that sometimes I'm scrolling through TikTok, I see the ads, and I say, that looks pretty good. And then I buy it. And then I get more ads. Let's talk about NVIDIA. NVIDIA, it's having its best streak in quite a bit. I think it's on track for a 10th consecutive day of gains. If that holds, Romaine, that will match its record long streak for consecutive wins. And you can see it's adding about 2% right now. This was a stock that was already winning. What a 2023.
Everybody knows NVIDIA. I have to say, you had another stock on that board that I saw a little bit earlier that I was not familiar with, that I'm actually furiously Googling right now. Beauty Health, ticker SKIN, which is down 62% for some reason.
I had to learn about this one. Third quarter results, other issues also led to several downgrades and price target cuts. Quite a whopping, down 62%. I have to check the market cap on this one, but at one point it was above $500 million. So this is a real company. It's having a real bad day.
Yeah, the market cap now down below 200 million. As we get closer to these closing bells, a focus on the broader market, a focus on the economy. Our cross-platform coverage starts right now.
Countdown to the close. Bloomberg's comprehensive cross-platform coverage ahead of the U.S. market close starts right now.
This is the countdown to the close. Romaine Bostick alongside Katie Greifeld, and we're joined right now by our colleagues Carol Masser and Tim Stenovic. Welcome to our audiences across all of our Bloomberg platforms, television, radio originals, and our partnership on YouTube, with stocks pretty much across the board up 2% here on the day. The Russell up more than 5%, having its best day going back to November of last year, and that all seems to be tied to that big CPI report we got this morning.
Yeah, showing that U.S. inflation broadly slowing. This was a surprise. I think people were expecting a little bit of a hotter print, and that's not what we got. Having said that, as it turns out, pricey watches, they are also seeing some cooling when it comes to demand as well as increased supply. So two factors at play. 2-year lows when you're talking about Patek Philippe watches, when you're talking about Rolex watches, falling to fresh 2-year lows. This is on the secondary market, and this was last month.
What? Carol's talking about watches? Where do we go?
Everything has a price, Romaine.
Thank you, Carol.
Do you know?
Is that the real economic indicator?
Well, you know how we always say the luxury market, it's immune, everything's fine? Well, it's interesting when you start to see even that come undone.
Yeah.
Here at Bloomberg, we have
Isn't
the
that like the
Bloomberg
ultimate discretionary item, though?
Hey, there's a Bloomberg subdial watch index.
I know.
So this
Did
is
I just
real.
say that? Is there an echo in here?
Deja vu.
Yeah, it dropped 1.8% in October, okay?
Wow.
So
Listen.
it tracks the prices for the 50 most traded watches by value on the secondary market, down 42% since a high back in April of 2022. So I guess the good news is if you're in the market for a Patek Philippe, maybe even a Rolex. If you don't want to go as high end as a Patek Philippe, Katie, for the holidays, maybe, then maybe it's a good time to pick one up.
I didn't even know what a Patek Philippe was, but good to know. I'm going to write that down.
There's a third company in here that's
affordable,
mentioned that I actually can't pronounce.
Where's Chris Rauser?
So
when
I'm
we
not
need
going to
it?
even
This
try.
is when we need Chris Rauser.
My strategy is usually to just barrel through it on live television, and it kind of
just own it.
Work.
Just own it, right? And people are like, wow, look at
then they know you don't have the watch.
So, okay, so maybe that's an economic indicator, one to keep in mind. Let's talk about another indicator. I loved this story on the Bloomberg terminal. You know how great quarter guys has kind of become a meme for what analysts say on earnings calls. Actually, Bloomberg crunched the numbers, and mentions of praise to executives for earnings calls, they actually declined by 29% quarter over quarter. Mentions are down 35% below the average pace in the previous 3 years. It's pretty amazing, and it speaks to how rocky things have gotten on the earnings front. Of course, this past season was pretty much a mixed bag. You had some standouts, but overall, it looks like analysts are praising executives less.
Yeah, I mean, well, are they actually deriding them, though? Because, I mean, those are the numbers I would like to see. And it's funny, because we have had that in the past. I mean, I remember the last big recessionary cycle we went through. You did, in the most diplomatic way, some of these analysts were basically like, look, what the heck's going on over there?
Do you hear that? Wait, that's the analyst community downgrading stocks to sells.
No, they don't do that,
It's
do they?
not happening. So they obviously don't think it's that
We were just talking about
bad.
Meta today, and there's like 78 plus analysts covering this company.
I was
and they got
just
like
gonna
2 sales
say.
on it.
I mean,
and
Meta's
6
having
holds.
a great year, so there you go.
So you have to go, in order to find out when people said good quarter, great quarter, congrats or congratulations, Katie, as few times as they said in the most recent quarter, you have to go back to Q2 of 2020, which was not a great quarter given that it was the start of the COVID pandemic.
No, that's the thing.
But they
I
still
guess
said great quarter 374 times.
I would like to go back to some of those
contraindicator.
transcripts because, I feel like around that time you had a lot of, people just banding together, maybe analysts congratulating the companies on managing at all. As we know, that was very stressful, a very strange time to be running a company.
So from now on, when there's an earnings release, you know what we're all going to be searching on?
Great quarter.
Great quarter. Yeah. Great quarter.
You know what? I'll be the first to say, great simulcast, guys.
Yeah, thank you, Tim.
Well done, well done. All right, guys, we're going to be back in.
It was okay.
Is that a hold? All right, we're going to be back in less than an hour's time. Our cross-platform radio, TV, YouTube, and Bloomberg Originals. Catch us on this Tuesday. We're going to count you down to the close at 4 p.m. Wall Street time.
And we continue our coverage right here on Bloomberg Television, counting you down to those closing bells. Just about 50 minutes until we get there, with stocks having a pretty monster rally. 2% gains on the S&P and the NASDAQ, almost 5% on the Russell 2000, but a ton of activity right now going on in the fixed income space. 20 basis points drops on your 2-year, your 5-year, and your 10-year yield right now. Who better to get some insight from than Priya Misra, fixed income portfolio manager over at JP Morgan Asset Management, who joins us live here in Studio 2 at our Bloomberg World headquarters. And Priya, I'm curious, first of all, about the knee-jerk reaction to the report this morning, and whether, when you look at what we're seeing in Treasury yields, Treasury prices, whether that's maybe a little bit overdone.
So the move today does look like a lot, but remember, in the context of the fact that in the last 2 months, 10-year rates rose by 100 basis points. I think it's been an extremely technical market. Once we broke that 435 level, I think that move from 435 to 5%, that big steepening of the yield curve, I think that was essentially the shorts taking over. So the market was extremely oversold. Then we've had this weaker economic data. We've had the Treasury responding to the bear steepening. We've had the Fed responding to the tightening in financial conditions. And then you get an essentially softer inflation print. So the market's reacted a lot. But I think, I would still say duration is attractive even with this move. Now, I wouldn't chase it, but I think buying backups, I think, the range is likely to be 4 to 4.5 in the near term. As the economy slows down, which we think we're heading into a hard landing, I think that even 4% is going to look attractive. But the trade for today is sort of this soft landing trade.
Well, I am curious then, because even prior to this report, there were a lot of big folks on Wall Street who were basically betting on a rally, basically to see a big move in prices higher, that drop in yields. And obviously, this was kind of a gift that I think was sort of outside the purview of their predictions to begin with. But you're looking at the latest Bank of America Fund Manager survey. You're looking at other data coming out of Goldman Sachs and PIMCO and a few others here. There are a lot of people now that seem to have conviction in that trade.
Right. I think it was like the perfect storm that sort of got the 10-year to 5%. You had a more resilient economy. You had stronger inflation. people sort of, staying in the very front end. There's $4.5 trillion of money sitting in money market funds. So this idea that, there's this supply-demand mismatch, I was arguing supply has been high for a while. It was essentially the buyers that stepped away. The fact that at an inverted yield curve, you're not paying me enough to take on that duration risk. I think what has become clear over the last couple of weeks is that the Fed might be done. I think today reinforces that. And then when you look ahead, it's either a soft landing or a recession. I think the market's been grappling over the last 2 months on a no landing scenario, where the economy is just not slowing, inflation's not declining, the Fed may have to hike a lot more. I think we can put that scenario behind us. So this, whether duration is an asset class or does it make sense to have duration in the portfolio, I think we've been grappling with that for the last 2 years. There's been no correlation, or the correlation's flipped. I think correlation comes back if the economy slows down. And today I have to say we saw more soft landing data. The economy's been slowing. It's not looking like a hard landing right now. I think that's the trade for the next year. If the economy does slow down much more, I think these treasuries are going to look very attractive against risk assets. But today is sort of a buy everything day.
Let's talk about how that translates into the yield curve, because you take a look at the 2s, 10s, and I mean, long end rates go up, long end rates go down. It seems like steepening has been the bias. And when you think about where we're sitting right now, negative 37 basis points, what's the dynamic that gets us back to basically positive territory? Is that going to be a bull or a bear steepening?
I think the bear steepening is done. When it spooked risk assets, when it spooked financial conditions, the Fed and the Treasury, I always think when the Fed and the Treasury get spooked, then you're not supposed to get spooked by that. So I think the bear steepener is done. The next move, I think the next big move is going to be a bull steepening, but that's going to require the Fed to validate rate cuts or talk about cutting rates. And I think the Fed is really far from there. I think even if the economy slows down, inflation is well north of their 2% target. I think the Fed lost a lot of inflation credibility, so the bar for them to cut rates is actually very high. So as much as I think in a recession the curve bull steepens, I think the steepener is going to run out of room. Because once we price in, we already have 100 basis points of cuts priced into next year. Unless the economy slows down really fast, I think the market's going to struggle to price in more cuts. So I think duration might be more interesting than the curve. I think rates can certainly fall, but it might be more of a parallel move because that 10-year is going to look attractive to people. I think the curve will require this idea that the economy is actually slowing down much more sharply than the data that we've seen so far.
Well, Priya, you brought up credibility, specifically when it comes to the Fed's inflation fighting prowess. But what about credibility when it comes to basically their forward guidance? I mean, we heard from Citadel's Ken Griffin saying that if the Fed cuts too soon, that would be a hit to their credibility. Does that argument hold water with you as well when you're thinking about the Fed's plans here?
I think so. I think forward guidance becomes really tricky at this point. Forward guidance also very tricky because the Fed has been head faked in the past, where inflation was transitory and then growth was supposed to slow down. I think when you have a data-dependent Fed that's also trying to, I think, finesse financial conditions, I think they're going to be very nimble. And I think it's very hard for them to look for the lags or to project or model these lags. I mean, I would argue, the Fed says that the lags are much shorter. I would argue that the lags now between monetary policy and the economy are actually much longer. Because corporates, households, everyone termed out debt. So I would actually ignore what the Fed says. We have to look at the data. And it's only when a recession is staring us at the face, I think, that they're going to start to cut.
Well, I'm glad you went there because I am curious. I mean, there's been a lot of talk. I mean, you mentioned corporate debt and even consumer debt and the idea that maybe the lagged effects of those rate hikes are really going to come back to bite. But there has been this sense that a lot of these, particularly on the corporate side, that a lot of companies that need to refinance are kind of buying time with the expectation that the Fed is done, and more importantly, they do think that maybe rates will come down here. Is that just a fever dream then?
Yeah, I think unless there's a real recession or inflation goes below 2%, the Fed's not cutting rates. So I think, companies have been holding out. If you look at net issuance, hasn't been that high in IG. If rates stay here, I think there's going to be real dispersion within the credit world. High cost of capital is going to be a problem for certain companies, certain balance sheets. I think it's very important to do that credit work now to see who can afford that higher cost of capital, whose balance sheet can actually pay that higher interest cost. Because I think if you're waiting for rates to come down, that's only going to happen in a recession, in which case earnings will be under pressure. So I think as investors, we all have to do that credit work, which you've not had to do a whole lot of that over the last 20 years with a very low cost of capital. I think that's coming back.
Priya, it's always great to see you, but especially on such a busy day like today. That is Priya Misra of JP Morgan. asset management. Now, coming up, we'll get more insight on today's inflation report and how it may influence the Fed. We'll do that with Dana Peterson, Conference Board Chief Economist.
And a closer look at shares of Snap rising today on the back of that deal that lets Amazon customers buy products directly through the Snapchat app. A closer look on what's driving that move.
And we'll count you down to the closing bell with Doug Ramsey. He is Chief Investment Officer over at the Leuthold Group. All that and more coming up. This is The Close on Bloomberg.
All right, one of the more meaningful drops that we've seen in inflation in this cycle is leading to, well, one of the biggest up days that we've seen in equity markets all year long. An S&P 500 and a NASDAQ, each up about 2% apiece. Some of the best gains that we've seen, at least going back to January. Meanwhile, the Russell 2000 is your big outperformer on the day, a 5% gain that, at least right now, if that holds, would log its best day in about 52 weeks here. So a bit of a broadening, not only in the rally, but more importantly in sentiment here. The idea, based on whatever you want to read out of this morning's inflation report, that the Fed might be done, and some of the, I guess, pressures that have been placed on valuations, whether in equities, whether in commodities, whether in the FX space, or, of course, whether in treasuries, whether some of those pressures may now start to dissipate if you do believe, indeed, that the Fed is done. That's the setup here as we round out into the final few minutes of trading here on this Tuesday afternoon. Let's bring Abigail Doolittle into this conversation, as we do every day around this time. It is our Options Insight segment. And Abigail, you're taking a closer look at China's technology and whether it's getting a pop on this week's APEC summit.
It's hard to know, Romaine, whether the pop has to do with the APEC summit or it has to do with this inflation print, because it does seem that the rising tide around this inflation interpretation that the Fed's fight is done is taking up most sectors, including China tech. To talk more about what it could be, let's bring in David Bauer of William O'Neill Securities. Great to have you with us here again, David. And so we do have China tech rallying on the day ahead of or into this APEC summit. What do you think the connection is? And it's such a beaten down, not really talked about sector. Do you think that that in and of itself is a reason to be interested?
Well, this is a big week for KWEB. You have Biden and Xi meeting tomorrow. And then you also had some positive tea leaves yesterday with Boeing and China weighing the possible end of the freeze of the 737. With KWEB, you have 45% of its constituents reporting this week, highlighted by Baba and Tencent. And then the derivatives group at O'Neill Securities was looking at buying calls in December because implied volatility in KWEB is actually hovering near one-year lows. And between now and December expiration, 84.5% of KWEB will report. And the sentiment on China is extremely negative. It's under-owned, and it's a perfect candidate for a laggard rally into year-end. And as you can see today with IWM and equal-weighted S&P, the breadth is really, really widening out.
Well, I want to ask you about that because we do have these other areas. Romaine was just talking about IWM or the Russell 2000, the home builders, autos. There's just pretty much any sector is up in a huge way. Those that have been down on the year, a little bit more beaten down, seem to be more. But KWEB is not outperforming as much as some of those other areas. And in addition, I would say it's still stuck in a range below resistance. The buyers aren't convinced. What do you think that those buyers need to be convinced, and how do you, I know you're talking about the December calls. Is that the real way that you would play it through options?
Oh, I definitely think so. I think into year end, you could get, as I said, it could be part of the laggard rally, and you're just seeing the relations between China and the U.S. becoming better. You saw Yellen meet with her counterpart last week, and I think you can see a positive inflection point.
Okay, so in terms of this year-end rally, it's way too early to talk about the official Santa Claus rally, which is right at the end of the year. But do you think that today is going to, we have retail sales tomorrow, we have PPI, there's a lot of important data points ahead, and we'll wait to also for the December meeting. The markets might think that the Fed is done, but the Fed has seemed to have a pretty different game plan than what markets have had over the last year and a half, while being pretty transparent. What do you think are the key drivers for this rally outside of inflation possibly being gone?
I think the market has some tailwinds. You have CTAs in buy mode in almost every scenario. the CTAs actually came in short in equities. And then you have the corporate buyback window, which opened up last week, and November and December are the biggest months of the year for that. And then, according to large broker-dealer PB data, you have nets almost only in the 30th percentile. And if we get a rally here, you almost have an implicit short gamma by the hedge funds to buy this rip.
So yes or no? It sounds like a yes. Buy this dip or buy the recent dip. Great stuff. David Bauer of O'Neill Securities, thank you for joining us for Options Insight today. And from New York, this is Bloomberg.
Well, it's almost bonus season, and on Wall Street, it's looking grim, specifically for bankers. And next year isn't looking any better. Data from Johnson Associates estimates that year-end compensation at some firms could fall as much as 25%. Interesting to break it down by category here. According to this report, Romaine merger advisors could see their payouts for 2023 slide as much as 25%. Meanwhile, at regional banks, maybe that number is a fall of 10 to 20%.
Yeah, a fall of 10 to 20%. We should point out that on the retail side, though, you are seeing some folks that are maybe potentially looking at an increase in their bonus over on a year-over-year basis. And I think with some of those multi-strat funds, at least based on their performance, I would hope that some of those money managers are going to get a big payout as well. But it raises the question here, too, that overall, even with those increases, they're going to be relatively minor. They're not going to be what we saw back in, 2021, when they were just literally just like dipping their hands into the piggy bank and, pulling out wads of cash like Scrooge McDuck. Yeah.
That really paints a picture, so I'm appreciative of that. But yeah, I mean, I think this really brings itself to that conversation that we've been having about talent wars all year. You think about bonuses, obviously that's huge on Wall Street, even though their base pay is very high. It's basically who can pay up for that talent.
But the talent wars too, they also have to do work. And as you know, I mean, there's just not a lot of deals. So I think a lot of these banks are sitting on some very high quality talent that is maybe not being utilized. Not their fault, but nevertheless, if the deals aren't there, then you're not going to pay out those bonuses.
Yeah, it will be interesting to see how this evolves. And,
I just want to know how this is going to affect the economy, because we always talk about these, particularly here in New York, because this is always a big part of tax revenue. Here, or those bonuses then get spent on new apartments and cars and eating out and a lot of other things. And I wonder if that drops.
It's all connected. Someone needs to ask Jerome Powell about how he feels about banker bonuses. Maybe next Fed meeting. I don't know. This is The Close on Bloomberg.
This is the countdown to the close. Just about 30 minutes left to go here in the trading day. The trading day that's shaping up to be one of the best of the year.
A big one. The S&P 500 up by almost 2.2% at the moment. You take a look at the circle behind me. It's all green. It's an everything rally. Up at the top, it's some of your rate-sensitive sectors. Real estate up by 5.5%. That's quickly followed by utilities up by about 3.9%. And it's green all the way down the board. But you take a look at what is the relative underperformer today, healthcare, but it's still up almost 1%. And energy at the bottom of the heap there, Romaine, up about 0.7%.
Yeah, more than 90% of the S&P members in the green here on the day, and that includes the big cap tech names, your favorites, including names like NVIDIA, up about 2% here on the day. 10 straight days of gain for NVIDIA right now. Of course, that's on the back of the monster rally that it had to start the year. The 10 straight days of gains, that's the longest win streak for NVIDIA going back to 2016. Meanwhile, AutoZone had actually been, believe it or not, on a 12-day run, and it had started off, it looked like it was going to be 13 on the day, but just over the last few minutes, flipping into the red, down about 0.5% here. And don't forget, we got a lot of earnings coming out this week in the retail and apparel space. We got On Holding, that's the sneaker company backed by Roger Federer. That came out earlier today, and there was a lot of concern here about the company's outlook going forward. The quarter behind us wasn't bad. The quarter going forward, though, did not necessarily look as strong as investors wanted. Those shares down 3%. And we get Target tomorrow before the bell. Those shares rallying hard here on some optimism here that consumer spending, Katie, will indeed hold up.
Well, before we get there, let's get back to our big story of today, and that's U.S. inflation broadly slowing in October, with markets erasing bets on more Fed rate hikes in the aftermath. Here to unpack it, I'm pleased to say, is Dana Peterson. She is Conference Board Chief Economist, joining us now. And obviously, you just take a look at markets. There's a lot of celebration over today's report. But I want to take us back to what Jerome Powell said last week, basically that inflation has given us a few head fakes, rather, and there's a risk here of being misled by a few good months of data. With that in mind, how are you viewing the numbers that we got for October?
Well, just like the Fed, we are very data dependent. Certainly today's CPI data, we're going in the right direction. Headline close to 3%, core close to 4%, and that's the direction we want to head in. But they're both still above 2%. And certainly there are lots of things that can happen that can impact the data: food, energy prices, or even the fact that home price valuations are rising, and that could affect what's happening with rent. So I think the Fed is cautiously optimistic that they're going to see inflation get back to target, but they don't want to declare victory just yet.
And with that in mind, you think about some of the aggressive cut bets that are being priced into next year. Is that a little bit premature?
I think so. Right now the Fed is probably on pause, though there is some risk that they hike at least one more time. But once they're done, they're going to stay on the sidelines for some time. That's the higher for longer sentiment. And we don't expect that they're going to even think about cutting interest rates until probably the middle of next year. And they're signaling only 50 basis points of rate cuts. That's not a lot.
So it's not a lot here, but it gets to this idea as to kind of what economy we're actually looking at going forward here. Because once you start looking at market pricing for rate cuts, I can only think that that materializes in a recession. If you look at the data that we got today and the market reaction that you're seeing in the moment, these are people betting on some sort of, I guess, Goldilocks or soft landing scenario. So square that circle. I mean, you can't have both, right? You can't have a Goldilocks scenario with the recession just a few months around the corner.
Well, I think it really depends on what your religion is about, whether there's a soft landing, no landing, hard landing. Our view is still that there could be a recession in the U.S. in the first half of next year. And a lot of that's a function of the fact that the Fed has raised interest rates very aggressively over a short period of time by a lot. And that's going to continue to slow the economy. We've already seen housing slow down. Business investment is not as robust. And we think consumers are going to follow suit. So that does not signal that the Fed would necessarily be cutting rates aggressively if you have a short and shallow recession. But if it is a deep recession, then certainly the Fed might cut more, and in line with what some folks are pricing it now.
I am curious, though, Dana, about, and I just want to kind of get away from some of the stuff that the Fed looks at, because there's been a lot of criticism that kind of what they're looking at isn't always a reflection of what's really going on the ground. And there's so much anecdotal evidence out there right now that, at least among a certain class of people, they are still feeling a lot of economic pain. Yeah, their wages may be higher. Yeah, they may have jobs, but they're still paying a lot more for their goods and services, the necessities, not just the discretionary items here. And I'm wondering if we are looking at an economy that is maybe weaker than what some of those headline numbers actually show when it comes to the consumer.
Well, definitely, when you look at people across the income spectrum, folks with less money always feel it more. So when we ask consumers how they're feeling about the economy, they're still saying that they're worried about the outlook. They're still complaining about elevated inflation, especially for food and energy, which are basics. Rents are still high, and they're concerned that their finances are not going to be as strong or their incomes as robust going forward. And they're also starting to worry a little bit about jobs. So that's all futuristic, and certainly consumers have spent a lot of money through the third quarter, but we think that's going to die down.
Maybe that will die down. That'll be interesting to say. And I want to go to one of the points that you make in your notes, that at present that your forecast still calls for one final 25 basis point rate increase in December next month. Is there anything that you would need to see to bump that down to a hold here? I mean, when we think about today's numbers, it seems like the definite consensus on Wall Street is that the Fed is done here.
Sure. Well, we still have more data to come in. We're going to have retail sales. If retail sales are are weak, and also if the PCE deflator comes in weak, and then when we have the labor market report for November, if that's soft, all those things suggest, yes, the Fed is done. They'll pause. They'll wait until the middle of next year. But if we have any surprises in terms of really strong retail sales or inflation going in the wrong direction again, or even another, 200,000-300,000 job additions, the Fed might say, maybe we need to do some more in order to bring down inflation.
I am curious about cycles in general, though. When we talk about the economic cycles and the need for a recession to kind of wash away the bad and sort of set us up for something good here. I mean, I guess technically we got that with the pandemic-induced recession here, but there are some people that kind of dismiss that and say that whole cycle that we had prior to that, we never really reconciled the excesses from that.
Well, I mean, we were experiencing a very long expansionary cycle right before the pandemic. And the thing is that was a great economy, really. And the only slowing we were seeing was in trade because of the trade wars between the U.S. and China. But for the most part, I still think that we would have been in an expansionary cycle, just slowing. But the pandemic really disrupted things, and we're still seeing the results of that. But I think we need to remember that this is part of the plan in terms of slowing the economy. That's why the Fed raised interest rates as much as it did to slow the economy, to bring down inflation. So the Fed is creating its own business cycle here.
All right, Dana, really appreciate you joining us. That is Dana Peterson of the Conference Board. Now coming up, Snap shares rising after reports of a new deal between the company and Amazon. It's our Stock of the Hour coming up next. This is The Close on Bloomberg.
Welcome back. It's time now for our Stock of the Hour. Taking a look at Snap, the shares higher on the day, in fact, at their highest levels since July. This after the company reported a deal with Amazon that will let consumers directly purchase products featured on Amazon ads. The deal comes 1 week after Amazon struck a similar deal with Meta Platforms. Mandeep Singh joining us right now. He's Bloomberg Intelligence's senior technology analyst. And let's start off here with what this means for Snap here. And just kind of give us a sense here. Had Snap not already experimented with this before?
No, so they had partnered with Shopify, so that's a company that Pinterest had partnered with, not so much Snap. And look, right now, the ads on social media are really cheap.
Yeah.
You see an ad pricing decline for the last 6 quarters on social media. Plus, there is a trend towards more brand ads on streaming sites or Netflix, Disney, your marketplaces, Uber, DoorDash are all showing brand ads. So there is a lot of ad inventory.
Well, just to be clear, so is Amazon paying Snap, right, for the ads on there?
Oh yeah.
And then when I click, if someone clicks on that ad, does Snap get a percentage of that sale or not?
Well, Snap gets paid for that ad slot. So because the ad pricing has been declining, Amazon being such a big buyer of ads raises that ad price.
Gotcha.
It's an auction mechanism. So clearly, having that big buyer of ads is a good thing for Snap. But in terms of the cut on a transaction, probably they're not getting anything. We don't know the exact terms, but my guess is they're not getting anything from Amazon.
What is the potential drawback here for Snap and for Meta, who I believe has a similar partnership? We were talking with an analyst earlier who said that basically a partnership with Amazon, it's a double-edged sword. Do you agree?
Well, so I look at it this way. I mean, Snap has a lot of ad inventory. So does Pinterest and Meta. They need more ad buyers. And Amazon is a big ad buyer. And so are Temu and Shein and all the other Chinese advertisers. So these guys don't really care about who is buying the ad and what they're doing with it. At the end of the day, it's an auction mechanism, and the more buyers they have, it's a good thing for Snap.
Can I tell you something I was surprised by? I was taking a look at Snap shares. Obviously, they're rising today. They're up 35% year to date. I mean, I guess that pales in comparison to Meta's year of efficiency, but it seems like it's actually been a pretty good 2023 for some of these social media firms.
Well, they were down 80% in 2022, so clearly I think there's a lot to catch up on. But look, in terms of fundamentals, these platforms give you the ability to target 15 to 25-year-olds. Where else will you find all the 15 to 25-year-olds besides TikTok and Snapchat?
All those millennials, Romaine.
Yeah, I mean, that's a good point. And I mean, just in our household, I mean, that is the social media site of choice, Snapchat. For a lot of kids. Yeah, I mean, that's what the kids are using.
And look at the overlap between Amazon Prime members and Snapchat users. Probably zero. So this allows them to, tap into these young users who can become Prime members if they like.
This reminds me, I need to set more limits on my son's credit card because every day I get these alerts from him buying, like junk out of the vending machine or something else. So God only knows now that he's going to get pushed these Snapchat ads. I'm going to start seeing like $100 charges for, a little avocado pen or something.
Delicious.
Delicious. Mandeep Singh. Also delicious and very smart. Bloomberg Senior Intelligence, Bloomberg Intelligence Senior Technology Analyst. A closer look at shares of Snap here, up about 7% on the day. That is our stock of the hour. Meanwhile, back to the broader markets, which are holding on to the gains as we get closer to those closing bells. Doug Ramsey, Chief Investment Officer over at the Leuthold Group. He's going to be stopping by the big program in just a second. Stick with us. This is The Close on Bloomberg. This is the countdown to the close. Romaine Bostick here, counting you down to the closing bell and beyond here on a day where we're seeing a very strong rally in U.S. equity markets, a 2% gain right now on the S&P 500, similar move on the NASDAQ. But this is the broadening of the rally that I think a lot of people have been looking for. A 3% gain on Dow Transports, a 4% gain on the S&P mid-caps, and a more than 5% gain right now on the Russell 2000. Some key technical levels being breached to the upside. That is a good thing, and a lot of questions about whether this actually lasts. You take a look at the 2-year yield right now, down 22 basis points here on the day, back down around 4.8, just a couple days after we were all sort of wringing our hands about that move above 5% and whether it would stay there. A big part of the reason why we're seeing those moves there, as well as similar moves in the commodity space, is that big downdraft that we're seeing in the dollar. The dollar spot index down more than 1% on the day. Worst day that we've seen for the dollar index in at least 52 weeks here. Something to keep an eye on as we move forward here. And the rate story maybe starts to gel just a little bit more to the liking of investors, but of course a lot of that will still be dependent on the data. At least the data that we got today seemed to be supportive of that, with the consumer price index now finally creeping back, at least on the headline basis, back down towards that 3% level, and everyone hoping it can breach it below. Don't forget, we do get producer price index data tomorrow, and of course that has actually been lagging the trend that we've been seeing on the consumer price side, so it'll be interesting to see if we see a little bit more melding of the minds there. And of course the PCE deflator, which is what the Fed pays most attention to, got to wait a couple more weeks to get the next update on that. Let's continue our focus here on the markets and the economy and everything driving some of the moves out there. Doug Ramsey, the Chief Investment Officer over at the Leuthold Group, joining us right now to help us count down to those closing bells. And Doug, let's start off first, of course, with that CPI report here. Overall, I mean, at least on the surface, this is exactly what most people wanted to see. And I know one report does not necessarily make a trend here, but do you have some confidence that we are still headed in the right direction on inflation?
I do. I think inflation is going to continue to drift lower over the next several months. The reaction is surprising because the beat or the undercut was not by a huge amount. I mean, there were some quirky things going on with respect to medical insurance, I think, that are unlikely to be repeated. But I mean, there's no doubt that positioning was very cautious coming into the report. I mean, that's the only thing that it could explain this type of market reaction.
Yeah, I mean, certainly so. I think a lot of people are caught off guard. But when you look at the report, I mean, you had, what was it? The core services inflation definitely slowed. And then even on core goods prices, you actually saw the contraction there. There has been some concerns, though, about sort of what's been driving that disinflation and whether we might be setting ourselves up for, I guess, too much of a good thing, if you will, and kind of overshoot to the downside in a similar way that we overshot to the upside.
That would be my fear in a recessionary environment, and where we are seeing disinflation, that if you're an economic bull, if you're in the soft landing camp, you don't want to see it, is in industrial prices. We watch an index called the CRB Raw Industrials, but there are a lot of indices that will tell you the same thing, that have undercut the lows they made earlier in the summer. And we like to compare that trend in industrial prices. And actually, Ed Yardeni was the one to come up with this concept, the boom-bust barometer. Mm-hmm. So it's the ratio of industrial prices to initial unemployment claims. So we've got half of what we're looking for in terms of a recessionary signal, industrial prices making a new low, but we haven't seen that definitive breakout in unemployment claims. Of course, they're very low. They have ticked up a little bit in the last few weeks. But, if we were to see a decisive rise in initial unemployment claims above their summer highs, which would be about, 255,000 range. I mean, lately they've been around 210, 215, 220. Mm-hmm. So that would be quite a rise. To me, that would confirm that the economic downturn is on, and, it could still be a few months away. I mean, the stock market may be telling you that here.
Yeah, I'm curious about them positioning right now. And I mean, maybe this explains, Doug, why so many people are on the sidelines, because it is kind of hard to know, just looking a few months out, even a year out, whether you're going to be investing in a relatively strong economic environment or one that is recessionary here. So how do you position if you are invested in this market and have to stay invested in this market by mandate?
Luckily, we're not in that boat. I mean, we're tactical by nature, so we're flexible with that respect. I mean, if the breadth that you mentioned continues, we will probably cover some of the hedges. I mean, right now we're 45, 46% equity exposure in our tactical funds. We can go as high as 70%. I wouldn't see us going there at this stage in the economic cycle, with still the brunt, the lagged impact of the tightening still ahead of us in 2024. And then also the valuations. And by the way, the valuation picture, just like the market, is very bifurcated, if you will. Very expensive valuations on the mega caps, but pretty good value now in the broader part of the list, because the broad list has languished now for a couple of years.
Yeah, but the problem, of course, as you point out, though, earlier, is that if that broad list, if we do head towards a recession, all of a sudden looks a little bit less attractive. Tie that in with what we're seeing in yields, though, because I would assume that if this is, I mean, I know the drop that we got today is a bit extreme, and maybe that gets clawed back. But if we do start to see a more persistent decline in benchmark yields here, does that change the valuation picture for the better?
For us, not a whole lot. I think, unless yields were to, the floor just completely fall out back down to, 2.5%. We've never been huge fans of the Fed model in that regard. One point I wanted to bring up here, and that I think maybe buys the economy some time, is this sharp drop now in the last 2.5 weeks in the 10-year. I mean, it has reinverted the yield curve. There was a lot of flattening going on. We were moving towards zero on the spread between the 10-year and the 3-month, and now we've blown that spread back out. Normally, as a recession is drawing near, you would expect to see that spread cross over into positive territory and begin to steepen. And by the same token, the stock market strength itself is, I think, something that tells us the recession is probably yet at least a few months off. Usually the stock market will sniff it out, a recession, as it draws very near. So if you're an economic bull, I think at least for now, both the yield and the stock market action have bought you some time.
All right, Doug, going to have to leave it there. Always great to talk to you. Doug Ramsey over at the Leuthold Group, helping us count down to those closing bells. And we should point out a 10-year yield right now at about 4.43 and change right now. That's down about 20 basis points from where we were just yesterday. And remember, just about a few weeks ago in late October, we were above that 5% level on an intraday basis. So we've come far pretty quickly here to the downside. It'll be interesting to see how that changes and how investors digest that going forward. Stick with us. Full market coverage coming up right here on Bloomberg as we take you to the bell and beyond.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine, Bostick here, counting you down to the closing bell, and here to help take us beyond the bell. It's a global simulcast with Carol Massar and Tim Stenovic. Welcome to our audiences across our Bloomberg platforms, television, radio originals, and our partnership for those folks streaming on YouTube. Carol Massar, last time we talked, stocks were pretty much where they are right now, and that's holding on to some pretty sizable gains, at least for some of the indices here. We're looking at what's shaping up to be one of the best days of the year.
Yeah, risk trade is on. Anything that's sensitive to higher interest rates are certainly rallying. Take a look at home builders, take a look at office REITs, and also take a look at the emerging markets index. I'm looking at the MSCI emerging markets index up 1.2%. The risk trade is investors just buying it across the board here.
I hate to be that guy, but we did speak to Ira Jersey a little earlier in the day, and of course he covers the bond market. He told us that there's some concerns that he's seeing in the bond market, Romaine, that the market's saying that, okay, you're going to get a better string of inflation data, but you're going to get worse growth data. So even though equity markets and equity investors are very excited today, there are some deeper concerns about what happens in the first half of 2024.
Absolutely, and we've talked with a lot of folks here on the television program about the idea of softer economic conditions in 2024. Doug Ramsey over at the Leuthold Group was just saying that you have to kind of position around that. He's not necessarily saying it's a done deal that we're going to get a recession here, but there's certainly some pillars of softness
This is
there.
Doug Ramsey?
Yeah.
Yeah, we just spoke to him last week.
And he even brought up something that Carol was talking about. I believe it was a couple days ago. We were kind of joking about the lubricant market here, but he was really talking about some of the softness that you are seeing in a lot of the manufacturing chemicals and manufacturing products here, and that's a sign here that we could see some more broader economic softness overall.
All right, see, lubricants, they're important.
Let's be careful, Carol. Let's walk through the numbers here on this Tuesday afternoon. A good day all around with the Dow Jones Industrial Average up almost 500 points, or about 1.4% here on the day. The S&P 500 higher by about 84 points, just a smidge shy of that 4,500 level that it did trade above. It's going to close right around 44.95 and change here. That's higher by about 1.9% here on the day. Best day for the S&P going back to January, and the NASDAQ up about 2%, or 326 points above that 14,000 level. But we got to talk about the Russell 2000, guys, because it was a phenomenal day for the Russell, a 5.4% gain on that index. Not only is that the best day going back to November of last year, but when you talk about the outperformance relative to the rest of the market here, and this has really been the bugaboo for so long, Carol, the idea that the Russell, the small caps, even the mid caps, were not keeping pace with some of those outsized gains we had earlier this year. Well, at least for today, those names are getting into the spotlight.
Yeah, very, very telling. You've now got the Russell in the green year to date. It's up just about 2% here. I just want to say, if you look at the S&P 500, Romaine, I mean, really broad-based, and we know this, right? We've got almost roughly about 466 names to the upside today. So investors were finding opportunities everywhere.
Another 90% day for the S&P as far as its individual members. All 10 of the sectors are higher on the day. And as far as the S&P groups, those 24 groups, all but one of them finishing today in the green. The auto sector, real estate, utilities, banks, in fact, really just pick any sort of interest rate sensitive sector, any sort of sector that is really either dependent on interest rates or directly affected by it. And those are your outsized leaders on the day. Meanwhile, the laggards here on the day, you can find that in telecom and insurers. Insurers as a group only down by a fraction of a percent here on the day. But remember, they had a pretty phenomenal run prior to today.
All right, and you definitely did say or see those interest rate sensitive stocks rallying in a big way. Take a look at anything to do with kind of alternative energy or solar stocks in particular. Look at the Invesco Solar ETF was up almost 11% at its high, finishing and holding on to that gain throughout the day. So up about 10% on the day following that CPI print. Another interest rate sensitive sector is the home builders. So if you look at that overall, that group was rallying in a big way and finishing the day with about a 6% gain. So again, saw that, and that 10-year yield. Obviously, you start to think about, do we start to see, kind of the mortgage market maybe even potentially come down longer term? Of course, we've got to wait for a little bit of a trend line. But nonetheless, home builders were rallying. Office REITs were also rallying in today's session. If you take a look at the S&P composite of office REITs, it was up about 11.5% in today's session. And then I just had to throw one equity name into there, NVIDIA. This was, as we know, it's the best performing stock in the S&P 500 so far here in 2023. It was up another 2%, its 10th consecutive session succession of gains, longest streak of advances since a record-setting dash back in December of 2016. So interesting to see that one also continued its run in this rally.
Yeah, some of these valuations are still going to have to be reconciled with at some point. I mean, absolutely phenomenal run on NVIDIA.
239%, I think, higher for the year.
Yeah, longest streak since December of 2016.
Yeah.
Wow. Okay, guys, I had to dig really deep to find decliners today.
Luck.
When 90% of stocks in the S&P 500 were higher, had to look long for stories about companies that were moving lower. Let's start with Aramark. Shares of Aramark dropped today, intraday the most since back in February. That's because the midpoint for the company's forecast for 2024 adjusted operating income fell below consensus estimates. It overshadowed its fourth quarter results. Shares falling by 8% today. You know Aramark, they do food and facilities management services. They do this at stadiums, at concert venues, uniforms, refreshments, work apparel, and more. So I wonder what that says about the 2024 outlook for those types of events. Also, Fisker shares falling today. This after the company's third quarter revenue missed estimates. The company said it found material weakness its internal control over financial reporting. Shares falling close to 19% today. It actually hit an all-time low. Shares are down more than 53% this year. It's lost nearly 90% of its value since February of 2021. And then Workhorse, speaking of all-time lows, shares hitting an all-time low today, though only closing down about 0.1%. Shares fell after the company reported net sales for the third quarter that missed the average analyst estimate. Romaine, back in 2021, this company had a market cap of more than $4 billion. Now it's $102 million.
Wow.
Yeah.
Okay. Well, that's not good.
No.
All right.
It's quite a decline.
To put it mildly here, I should just point out too, we need to talk about yields. But I was just trying to look at the last time we really had a day with this type of breadth here, and you really have to go back pretty far here. We had a couple days over the summer like this, but really right now this looks like you kind of have to go back to March of this year to find anything really comparable.
Remarkable, right?
Yeah, remarkable. And not only that, it's kind of similar story in the Treasury market. You're looking at 21 basis points lower on the 2-year yield. Again, you got to go back to those big ructions that we had back in March to see a downdraft in yields that were as severe as what we saw here on the day here. The 10-year yield down about 19 basis points, and your 30 and your 20-year yield down about 13, 14, 15 basis points overall here. And it gets to this idea about, I guess, what's now being priced in. After that CPI report, we saw a huge repricing in the swaps market of Fed rate expectations. The idea here that not only is that rate hike that the Fed and Powell convinces us is still on the table, is going to be off the table, but that we could actually start to see those rate cuts kick in relatively soon. And Ken Griffin was asked about this. Sonali Basak had a chance to sit down with him down in Miami earlier today, and he said, look, this is now a credibility issue for the Fed. I mean, this isn't like, oh, look, okay, we messed up the first time around, now we're going to mess up again on the other end here. He's basically saying that this is kind of a make or break moment for the Fed to kind of, I guess, really pay attention to the data and be prudent in its next move.
Yeah, if 2% is the target, 2% is the target, right? So you've got to kind of stay the course. I mean, he also, Griffin, that is, thinks what the 10-year should be about 4.5% here. So what are we at? Finishing at about 4.44. Yeah, so pretty much where we are.
I would also say that we've heard many, many times from the Fed chair and from all the Fed speakers that they're looking at every little bit of data, not just one piece of data. And to that end, we do still have a lot more economic data that comes before the December meeting. And indeed, we have tomorrow. We have PPI and of course, retail sales as well. So the question is, does it continue to support the narrative that, inflation is indeed easing, that that narrative that started a couple weeks ago, Romaine? Or does it kind of throw some water on that theory?
Yeah, I mean, I was also looking too. It's one thing that got really overshadowed by the CPI report today was some of the earnings that we got, particularly out of Home Depot, which they weren't awful, but when they start talking about people aren't spending on big ticket items anymore, just flat out.
I heard what they said, and I thought Home Depot stock would go lower as a result, but no, stock rallied
it was going to be one of my gainers, and essentially analysts, better than feared. It's apparently a thing. So much for great. Now it's better than feared.
Well, then what's the setup into tomorrow? Because when you go hear from Target, I think it's tomorrow, TJX, if I believe, is also tomorrow, and then later in the week we get Macy's and a few other names here. I mean, the end of the day here, you have a consumer that we know has cut back, at least on the good side of spending here. And we even saw softness on the services side. And in fact, some of the disinflationary trends we saw in that report with core goods actually contracting and core services declining, or the slowing, I should say, the pace of inflation, that seems to be more of a reflection of demand.
Well, maybe we have to kind of separate what we heard from Home Depot today with what we're going to hear from these other companies. I mean, we talked to Mark Bitzer over at Whirlpool a few weeks ago, and he basically said, okay, people aren't redoing their kitchens anymore, but if they're and buying new refrigerators, but if their refrigerator breaks, they are going to go out and buy that new refrigerator.
Replacement, right? But
replacement, not discretionary. So I don't know. I agree that later this week with the other earnings we're going to get.
I mean,
well, with the real estate market kind of seized up around the country, I think that kind of makes sense for a Home Depot, for a Lowe's. But
I mean, it makes sense, but
we'll
you
see
just
what
can't. I mean, you're just going to put all your things on replacement.
No, if they break, you got to buy a new
Okay,
fridge.
well, if Ted Decker over at Home Depot, if he wants to go to everybody's house door by door and break their refrigerator, they can buy one. Isn't that like how the mob used to do it back in the day? You know, they come and break your window.
It doesn't seem like
by
an
the way, we
efficient
happen
way.
to also run a window
I don't know.
replacing business.
I don't have a mob in
Carol,
my
you know
neighborhood.
about. You're from
Although
Jersey.
I am from New Jersey.
Yeah.
All I will say is that retail sales number, which is looking like a lot weaker than what we got the month before, this is going to be an October read. September was pretty strong. I'm wondering how much of the tone in the trade could it potentially change dramatically? If it came in really strong, would we see a different trade potentially?
Yeah, absolutely. And I do wonder whether some of the gains we saw today get clawed back. I mean, you mentioned the retail sales report. Don't forget, we still got all the nonsense in Washington that, in theory, needs to be resolved by the end of the week.
They're going to get it done.
They're going to get it done?
But are you lonely today, Romaine?
Only one. It felt like there was two. Like, wow,
do you want us to hang out with us? Do you want to hang out with us for the rest of the hour?
Personality.
I'm sorry, what?
All right, we got to
like it.
run.
I
We're
have
going
all
to
the
get you out of that.
space.
Goodbye. We'll see you tomorrow. Our cross-platform radio, TV, YouTube, and Bloomberg Originals. We'll see you tomorrow, everybody.
Some breaking news taking place right now. JP Morgan CEO Jamie Dimon is speaking right now, I believe down in Mexico City with our affiliate El Financiero. Let's take a listen in as to what he has to say.
To wait to see the effect on the economy in the U.S., particularly as the fiscal spending, the excess fiscal spending is winding down and quantitative tightening is kicking in. But I still think you should prepare. They might have to do a little bit more. And I think people should be prepared for that just as a kind of a risk management tool. And I'm afraid inflation may not go away that quickly.
Okay. And well, also 3 months ago, Fitch Ratings downgraded U.S. credit rating, and this weekend we saw Moody's changing its outlook on the U.S. credit rating to negative, pointing to a sharp rise in debt servicing costs and political polarization. What do you expect in these terms?
I find it a little ironic that Fitch and Moody's are doing that today. So here's what I think. They are right to point out those issues. I would take polarization off. That's always been true in a democracy. But yes, we have far more debt and more debt financing. We've been a little profligate when it comes to that. But the market is pricing us as AAA, which I think is more right, and the market will be more right than the rating agencies. I also want to point out, I find this almost funny, they have a lot of countries rated AAA. They all live under the protection of the American military. And so I think it's a little peculiar that that makes them AAA, but not America. So America will be fine, but we got to get our hands around these problems. They will not age well. The deficit's a lot bigger this year than we thought. There may be consequences of that. And so I think they're right to point it out.
Okay. And talking about your bank, Jamie, how would you sum up this year, 2023, given that it was such a tough time for the broader industry?
I don't look at any one year like it's a mystical thing. I always tell people the profits are like the tip of an iceberg that's bobbing in the ocean. The real quality of your company is your people, your systems, your technology, your products, your services. So we had a good year financially. I know that some banks had some problems. We've been quite clear we're over-earning. But to me, the important thing is that we're going to serve our clients through thick or thin. We've got plenty of capital, plenty of liquidity. We're not going to panic. No matter what happens in the environment out there, we're going to be in Mexico serving your clients, your country, the way we should be. And, I think if rates, and I'm hoping that the First Republic, which we bought, was probably the last domino. But I've always said, provided rates don't go up, we don't have a recession. And I do think banks are being prepared for that. That's just a reasonable, thoughtful risk management tool. Be prepared for things you don't expect so you can continue to build your company.
How to prepare for the things that you don't expect?
The way we do it is we model out how we would do in 2% interest rates and 7% interest rates, how we would do with credit losses going up, stress testing markets around the world. So we do like literally 100 stress tests a week. And so always looking at that so we can manage through that. And then under all those circumstances, we're fine. Fine means to me that you don't have to announce massive layoffs, you don't have to like pull out of a country, that you can continue to meet the commitments you have to the people in the country and the countries themselves. You know, people don't like banks who are fair weather friends. And so, you know, we're going to be there for people all the time. And, you know, we've always been careful how we run the bank.
Okay. Jamie, we have a question from the audience of a big fan of yours. He says that if there is really a future for fintech startups, or will they be outlasted or out-innovated by banks?
Yeah, I think it's the wrong way to look at the question, like it's a binary answer. You know, there will be some who will not survive. There will be some who are very smart and they have a great niche idea. There'll be some who are more than that. You know, so JP Morgan, we look at all the fintech. We also look at the big tech. You know, we have competition effectively from Apple, Google, Facebook. And so there will always be survivors. And, you know, our job is to make sure we're lean, we're mean, we're thinking, we're competitive. We're not, it's always better to assume that some of these people will be successful than to assume that they won't be successful. And, you know, I've pointed out to our own management teams that there's some great companies out there that we could have built and we didn't, like Square and Stripe. And so, you know, you got to be open-minded and a little humble about what's going to take place. Your size alone is not going to make you succeed in the future. And if you don't believe me, read about the history of all large corporations.
So you see fintechs working with big banks around the world?
That's true too, by the way. We partner with 50, 60, 75, maybe even 100 different fintechs, depending how you define that, in terms of data and cybersecurity and marketing. And yeah, we have quite a few partners we work with.
Okay, and which are your perspectives of fintech for Mexico and the region?
Well, I'm not an expert in that. I do know that I've learned a lot traveling this region from fintechs, but I'm not quite an expert what's happening here. But I think my view is you're developing a tech sector here, including fintech. Like, you know, in the old days, a lot of the technology was taking place in Silicon Valley or in Boston.
And we're listening right now to Jamie Dimon. He is the CEO of JP Morgan Chase, sitting down with a televised interview with our affiliate in Mexico, El Financiero, a wide-ranging assortment of questions here about the economy, about his own business as well. He was asked about the Fed and whether the Fed was doing the right thing, and he did say he did think it was the right thing for the Fed to pause its rate hikes now, though he did hope that the Fed doesn't actually overreact to some of the latest data out there on inflation, what he calls short-term measures that should be more focused on some of the longer-term measures. He also talked about JP Morgan's business down in Mexico and opportunities there to grow capital markets in that country. And the last question there before we broke away, a question about fintech and the future of fintech and JP Morgan's role in it. A wide-ranging interview here, and we'll, of course, bring you any updates here on anything else that he says of importance here on a day where the market has really digested the latest economic data, the latest inflation report, and the digestion was, well, outperformance here for the broader market. One of the best days that we've seen for the S&P 500 all year, and you take a look at the Russell 2000 there. The outperformance that you're looking at, you haven't seen that outperformance in the Russell 2000 on a percentage basis versus the S&P 500, basically since some of the big upswings that we saw coming out of the downdraft of the pandemic in March of 2020. This is the mojo that a lot of people wanted to see back into this market, some sort of ratification of what could come next. What could come next needs to involve a much broader rally than just the Magnificent Seven. The Magnificent Seven did participate in this rally, 2% gain across the board for them in an aggregate basis. But so too did banks. The KBW Regional Bank Index having a whopping day, up about 7.5% here on the day. And of course, all of this tied to some of the correlations and the negative correlations that we're seeing right now in the FX space as well as in the Treasury space. The 2-year yield down 20 basis points here on the day. You have not seen a drop like that since March of this year. Some of the individual gainers here on the day, you're taking a look at some of the retailers, including Target and TJX, companies that we're expecting to get earnings tomorrow, and as well as some of the tech companies as well. Cisco and Palo Alto Networks also scheduled to report earnings tomorrow as well. Let's get some reaction from some of the guests that have appeared here on Bloomberg to that blockbuster CPI report and the market reaction to it.
We certainly see the early signs of a slowdown.
We're sort of gradually sliding into a softish landing.
Potential for a soft landing is still there.
Across the board, there's disinflation in the U.S. economy, and we're heading back to 2%.
We're probably past the point now, at least with conditions remaining as they are for the Fed to hike again.
The Fed is done.
The Fed probably is done.
That period of pause has now begun.
This is a fantastic environment where they're probably not going to have to do anything else.
Next year, they will begin to open the window to lower rates.
If they are confident that things are really going to slow down, then they could start to cut rates, maybe summer or so of next year.
Some of the voices we heard today in reaction to that consumer price index report, and of course, an outlook as to what they think the Fed might do next, and more importantly, what they won't do. Bloomberg cross-asset reporter Emily Greifeld joining us right now to talk about what the market is now starting to price in here. And this is a pretty big pivot. And I'm curious, Emily, whether there's any sort of sense here that this is sort of broad-based conviction, or whether we're just dealing with kind of that small cohort of people that have been moving this market all year long.
Well, certainly, Romaine, when you look at the price action in the bond market, this really was a turning point. And I think a lot of my sources who were more bullish on bonds today were pointing to the fact that this is now in November, the second really significant economic data report that we saw come in softer than expected. We started the month with that weaker than expected jobs report. Now we have this. And even within the stock market, I wasn't expecting to see this much of a rally today. The options for the S&P 500 were actually only implying a move of 0.8% today. And if you look at all of the other CPI days in 2023, the S&P 500 didn't really move that much. So today, to really see stock bulls come out, move the S&P almost up 2%. It does feel different here.
To move the S&P more than 2%, we talk about 94, 95% of the members were higher on the day, something we haven't seen going back to March. But what do you make of the outperformance that we did see in the mid-cap space, in the small-cap space, and really for a lot of those cyclical names that really everyone shunned because they just said either the valuations were too out of whack or we're headed for a recession, so all those names are going to be trash anyway?
Yeah, it's interesting because if we see deflation, it's really hard to tell, is that a soft landing or is it the beginning of an economic slowdown? And I don't think it's really clear yet. Which one is it? Why then would you pile into small cap stocks when you also look at some of the more risky speculative areas in the market? The Goldman Sachs, they have a basket of the market's most shorted stocks. It was up 7% today, biggest gain since February. So sometimes that's a sign of a little bit of a short squeeze when you see the most hated parts of the market actually rallying the most.
Now, only time will tell whether today was truly sort of that inflection point for the market, not only for equities too, but we were just showing yields there too. And it was interesting to see the big drop in yields today, particularly given in the days leading up to this, we had a lot of stories in the Bloomberg terminal about a lot of people really starting to turn bullish on treasuries, basically saying that this is it. This is the price rally. It's finally set to come. Now, I don't know if they really predicted what we were going to get today here, but there were some pretty big heavy hitters who basically said, look, we're going to see a big shift right now in yields as we move forward because the peak was already there.
Yeah, and we were seeing, actually, when you look at the ETF space, some cash-like ETFs saw outflows. So it could be a sign that people who are in the shorter end of the curve are now looking to extend duration on this hope that rates have peaked. Bryce Doity is a portfolio manager, and he focuses on fixed income. And I was talking to him this morning. He said anyone who thought that we weren't at peak rates has now thrown in the towel this morning. They're piling into bonds. But it does bring us to this interesting question now for Powell. If bonds rally too much, if yields drop too much, does that loosen financial conditions and undo some of the work that Powell is trying to do in tightening? Would we be back to, square one in a month from now, talking about rates needing to go higher?
Yeah, that's a good point here. Of course, you did a lot of work trying to jawbone the markets into those tighter financial conditions, and you can see how quickly that changes here. Bloomberg's Emily Greifeld, our cross-asset reporter here, keeping an eye on what is and what will be one of the biggest days of the year for financial markets. All right, stick with us here. We got a lot more coverage coming up here on the big program. We need to check in on Washington because Friday, November 17th, is the deadline to pass some sort of budget compromise. And we are learning now that maybe the Speaker of the House, Mike Johnson, has a compromise in hand. We're going to check in on Washington and where we stand after the break. This is The Close on Bloomberg. Welcome back to The Close here in New York with an eye on Washington, the floor of the House of Representatives, as lawmakers there prepare to vote on a stopgap spending bill proposed by Speaker of the House Mike Johnson. It's coming just 3 days before a potential government shutdown. Joining us right now is Bloomberg's Cathie Wood, a co-host of Balance of Power, to talk a little bit more about what we know. And let's just be clear, the fiscal year for the government ended about a month and a half ago. We still don't have a permanent budget, and this isn't a permanent solution, but it is a stopgap measure that I guess will carry us through what, January, February?
Well, it'll carry us through both, Romaine, depending on what funding you're talking about, because what is on the table here is a two-step continuing resolution. Part of the funding will expire on January 19th, and then a second part of funding goes till February 2nd. That would include things like defense, some of the bigger ticket items. That is what Speaker Mike Johnson is trying to get over the finish line here. To do so, he will need 290 votes because this is being brought to the floor under a suspension of the rules. That means it will require a 2/3 majority in order to pass. Now, we know because this continuing resolution is what we call here in Washington clean, meaning it doesn't cut spending. It instead keeps it at levels that it already is going to lose some support among conservatives who wanted to see those deep spending cuts. That means Democrats are going to be necessary. And in that vein, Romaine, we just got a statement out from Democratic leadership, including Hakeem Jeffries, saying that they will support this continuing resolution.
Well, I am curious. I mean, you said 290 votes to get across. I mean, the Republicans, last time I checked, have what, something like 221 members in the House of Representatives. So, I mean, we're talking about, what, roughly 70 members on the Democratic Party, in theory, would have to go over and support this. And that's assuming that all the Republicans also support it as well.
Right, which likely is not going to happen. There's already been a number of Republicans who have come out and said they aren't going to support this measure. But Democratic leadership saying they will support it suggests that the majority of the caucus is going to be in line on that. We've had suggestions in that vein throughout the day. What's interesting, Romaine, is we've seen this before. A clean continuing resolution passing with Democratic support is what got Kevin McCarthy ousted from the speakership in the first place. So the question is, assuming this passes the House, and it seems likely will pass in the Senate as well, given the remarks we've heard from the Senate Majority Leader Chuck Schumer about how he expects the Senate will act quickly on this. If this goes through, it becomes a question of what becomes of Speaker Mike Johnson then? Is he going to be treated with perhaps a bit more grace compared to his predecessor on this front?
Well said. Cathie Wood, you can catch her as co-host of Balance of Power, which comes up at the top of the hour right here on this network. We will be keeping an eye on that vote, and we'll bring you the results as soon as we get them. Meanwhile, coming up here on The Close, we're going to talk about those 13F filings of the biggest institutional investment managers. They finally disclosed what they bought and sold in the third quarter. This is Bloomberg. Romaine Bostick here with a look at how markets performed on the day, and a good day it was indeed. In fact, one of the best days of the year for most of the major indices. The S&P posting a 1.9% gain, something we haven't seen going back to January. But really, the big story was the breadth behind those gains. More than 95% of the members in the S&P 500 in the green on the day. Once again, something we haven't seen in several months. And the outperformance that we saw in the small caps, in the mid caps, and some of those cyclical names, a Russell 2000 posting a 5.4% gain. That's more than 3 percentage points higher than what the S&P 500 posting, a differential to the favor of the Russell 2000 that we haven't actually seen going back to March of 2020. That was the setup, and that setup, of course, on the back of that CPI report, a CPI report that has a lot of people saying that the Fed has to be done. Meanwhile, the deadline for institutional investment managers to release their 13F filings is here. Those 13F filings will disclose what those funds bought and sold in the third quarter. They'll give us a view into what managers, well, the sentiment that they have around this market. Hema Palmer all over this here as our hedge fund reporter. And Hema, let's just get right to it. I know there are quite a few big names that we're still waiting on, but we did hear from a couple, including Michael Burry over at Skyon Capital. And I thought it was interesting. He sold a lot. He liquidated a lot of positions. And apparently he's also making some big bets to the downside for some of the big chip stocks, which, of course, have been the big gainers on this year.
Right, yes. So he covered his bearish bets on the S&P 500 and on the NASDAQ 100 index. But he did put on a bearish bearish bet on a basket of semiconductor stocks, including NVIDIA, which is pretty interesting. He got out of a number of his stock holdings, so now he holds just 13 long equity positions. He sold about 23 of his positions. And so that's pretty interesting. You know, we're seeing some reduction in his portfolio exposure, but also a covering of his shorts. So it's always a little bit tricky to tell exactly what the portfolio managers are thinking when it comes to their 13F holdings, but it does give us a little bit of insight into these funds that are pretty secretive.
And we should just point out for our viewers, I mean, these come basically 45 days after the end of the quarter, so it's very backwards looking.
It's very
and we really have no idea what's happened in those 45 days, whether he's re-upped those positions or changed them anyway, right?
Yes, yes, these are backwards looking, and so they don't really tell us what the portfolio does look like now. It also doesn't show us shorts. So we see one side of a trade, but if a fund has hedged that position, we don't see the other side.
Okay, well, let's talk about some other folks. Every time these filings come around, everybody sort of looks at the Tiger Cubs, the Robertson disciples, if you will, who have gone off to bigger and better things. Are they actually doing bigger and better things?
So they're kind of interesting. We're seeing some nominal moves. If you look at Tiger Global, they mostly bought more of what they like. So they re-upped their better positions that they're keen on. They did take a pretty interesting, chunky, sizable position in C. They already held some shares, but they ramped it up a fair bit. And that's a company that the stock has kind of tumbled in the past quarter. So it appears to look like they have bought the dip on that. If you look at Co2, they sold out of 13 of their positions. They only bought 9 new stakes, so it looks like they're kind of just keeping going. No huge buys, no really interesting sells. They took a new stake in Shopify and Alphabet. I think they've been in Alphabet a couple times before. If you look at Viking, it's kind of interesting. They did make some big swings. So their top 3 holdings are new. Positions they've held before, but they're sizably upsized.
Anything notable?
Yeah, so like Workday, they've bought millions more shares in Workday. Amazon and United Parcel, these are now among their biggest holdings, and they previously weren't.
I'm curious. I mean, I know we haven't gotten all the big companies out yet with their filings, but what we know so far, was there any trend that you saw in all this, or is this just kind of a hodgepodge of holdings?
It's a little bit of a hodgepodge. We're seeing generally, sometimes we will see big swings. We'll see funds really make a big jump in or out, or a big directional bet. Sometimes we'll see really big changes on their equity market exposure. This quarter, we're really not seeing that many big jumps. So Viking did make some interesting buys or interesting increasing of its holdings, but we haven't seen a whole lot of very noticeable things. Also, typically by now at this hour of the day, we have usually seen more filings come through. It does look like this quarter maybe some of the funds are procrastinating a little bit, waiting till the end of the day to get those filings out. Interesting, Cooperman. He took a stake in Manchester United.
Oh, yeah. I think I saw that headline a little bit earlier. I mean, everybody wants a stake in that, right?
There you go.
Yeah. Has that been sold yet, or are we still waiting on that
No,
thing
I think
to sell?
it's still in its bidding war.
All right. Hema Palmer, who covers hedge funds for us. So look at some of the 13F filings that we've gotten already. And, of course, we stand on watch for any others to cross the wire. We want to keep the conversation going right now with the co-CEO of Titan, Clayton Gardner, joining us right now. He's a co-founder and co-CIO, I should say. It's an investing platform that uses 13Fs to develop equity strategies. And Clayton, I guess I'm going to pose a question that I posed to Hema just a second ago. I mean, to use that as a strategy, I guess people are trying to look for trends here. And are we seeing any real material trends coming out of these reports so far?
Well, first off, thanks for having me. And echoing what your colleague said, it is important to note the 45-day delay because principally all the large funds must make these filings every quarter. I think it's important to understand who the filings may be more representative of. So for faster money funds or more macro funds that are using all sorts of exotic derivatives, short positions, et cetera, they may not be a great reflection. So you may not want to read into it too much, but for some of the Tiger Cubs, for folks that are maybe medium or longer term money, where they're not turning over positions very often quarter to quarter, the 45-day delay may not mean too much differently than what the underlying portfolio represents. Of course, things could change. I would say most notably, you did see some trimming in a lot of the mega cap tech AI beneficiaries, a lot of the stocks like the NVIDIAs, Microsofts, Alphabets that have powered the market to where it is today this year. You did see some trimming there. And so one could say that funds have pared back their net exposure. But importantly, remember, that was as of September. So that may have been a really shrewd decision if you look at the drawdown we had in October. That could have saved them quite a bit of losses. But we've since rallied back incredibly strongly in November. The S&P up 7%, the Nasdaq up 10%. So it really depends on how they've reacted and navigated. And to your point, on today's move, you could see a little bit of chasing.
Yeah, and we should point out too. I mean, for example, we were talking about the disclosure over at Sky on Michael Burry's firm, and disclosing reducing positions and names like NVIDIA. But when you look at some of those names, which of course many have actually doubled on the year, and I think NVIDIA has more than tripled on a year-to-date basis. So even if you did sell out, I guess, at the end of the quarter, and maybe you missed out on the little bit of upswing here, you're still printing on sizable gains. I am curious that for those folks who are closing out some of those positions or reducing them materially, is that cash actually flowing anywhere else material?
Well, it's a great question, and it really depends on the short side of the equation, right? Short positions are not reported, and so to have an accurate perception of one's net exposure, a fund's overall exposure to the market, you need to capture those shorts. So we don't know the short side of it. I would say what I'm hearing across the ecosystem is some funds have been lightening up, and in other words, they're holding that cash as dry powder. Perhaps some of them used it on the pullback we saw in October. Again, we would not have seen that in the 13F filings. So they could already have reinvested that cash and then some. And days like today lead me to believe that there's a little bit of a chase going on, and a lot of that cash may have found itself to work in non-tech names, right? Industrials or cyclical, some of the stuff powering the market on days like today.
This gets to the thing too, that for investors, I mean, who sort of, I guess, track this stuff, meaning those folks who are trying to look at what these big fund managers are doing, and either they're trying to replicate the trade or at least have some sense here of the thinking behind some of those trades so they can make their own decision here. How reliable do you think some of these reports are in that sense, given the delay, given the 45-day delay, and that you just don't always know whether these people have kind of changed positions or kind of setting folks up for a bit of a rug pull?
It's a great question. I would say it really depends on the game you're playing, and you have to look for funds that are playing a similar game. For longer-term focused investors, 13Fs can be a really fertile source of idea generation, right? If you're looking at a fund like Berkshire Hathaway that turns its portfolio over, very seldomly, a new position could give you meaningful insight into some new business or some fallen angel that's all of a sudden available at an attractive price. If you're seeing a fund or manager with hundreds of pages of 13F filings, they own thousands of securities, it's extremely unlikely that there's material statistical signal in trying to copy what they do. So in other words, can be a fertile hunting ground for ideas that one may then want to go do their own research on, but in my opinion, not a strategy to be leaned on as a foolproof one in every market environment.
I do kind of want to look forward a bit, and we don't have to get too much into speculation, but I am curious as to kind of what the 4Q reports might look like when we get those in, I guess, mid-February or whenever, because there's a sense here that if you are starting to see that profit taking, and you don't necessarily see the appetite to re-up into new positions in some material way here, this would seem to suggest that we're kind of setting ourselves up, at least the broader market is setting ourselves up for some degree of softness going forward.
I think it's a very fair concern. I would say the counterpoint to what I'm hearing out there in the market is there is a lot of dry powder. I think Bloomberg has talked at length about the surge into money market funds amidst 5% plus interest rates. That cash is still sitting on the sidelines. And so despite managers maybe trimming at the margins, mega cap tech names, some of the AI beneficiaries that have moved so much year to date, there is still material net exposure room to move higher. And there's a lot of cash on the sidelines. So and again, months like November thus far suggest anything could happen between now and the end of the year. So I too am fascinated to see and anxious to see what 13Fs look like.
Yeah, yeah, absolutely. I mean, there's a reason why we all pay attention to it. Clayton, great to catch up with you. Clayton Gardner there, co-founder, co-CEO, and CIO over at Titan, an investing platform that uses those 13F filings to look for equity strategies. All right, stick with us. Coming up after the break, a deeper dive into the retail space, a deeper dive into consumer spending, those Home Depot numbers that we got this morning, the first of the major U.S. retailers to report quarterly results. The big question, is that going to be a harbinger for things to come? Seth Basham over at Wedbush going to be joining us after the break. This is Bloomberg. All All right, the part of the earnings season where we get those retailers officially kicked off today with Home Depot's results. They came out this morning, and it was a bit of a mixed bag. Net sales, they were in line with most estimates. Comp sales, they were down 4% in the quarter. And the CEO there, Ted Decker, says the company has experienced pressure in certain big-ticket discretionary categories here. Nevertheless, investors shrugged it off, saying it was better than feared, in fact, pushing the shares to their best day in more than a year. Seth Basham joining us right now, Managing Director for Retail Hardlines Equity Research over at Wedbush Securities. And Seth, let's start off here with the investor reaction. I do wonder if the investor reaction today was very specific to Home Depot's results, or whether the shares just kind of enjoyed the broader market updraft that we saw today.
It certainly was a combination of the two. I think without the broader market updraft, the stock would have been up maybe 2% like it was pre-market. The strength in the market certainly drove the stock up the additional 3 to 4%.
I mean, I understand why investors looked at this and say it's better than feared. I think the expectations coming into this quarter were pretty low. But when you listen to the commentary from Decker and a few others on that call about the big ticket items, the idea that we aren't necessarily going in there and buying new refrigerators and washing machines and other things like that, did that give you any worry?
Yeah, that's certainly a cause for concern. And we've seen that trend exacerbate, get bigger over the course of this year. And I think that for the Home Depot, we're going to see that pressure continue into the first half of 2024. When we think about other players within the hardline space that have even more exposure to big ticket discretionary items, they're going to see the pressure as well.
Well, that's what I'm curious about, whether this ends up just kind of becoming something that's segregated to Home Depot and others of their ilk. Because, I mean, look, we know it. Those big ticket items like a refrigerator, like appliances and things like that, you don't need to buy them every day or every year or whatever. You keep those things presumably for years on end here. When you look ahead, though, to some of the other retailers, like the Targets of the world and the Best Buys and even things like Etsy, you're talking about discretionary items that are a little bit more fluid, that people, if they bought that discretionary item even 3 months ago, they would still maybe have a reason to buy it again today.
Yeah, for some discretionary items, that's the case. For others, you buy it once every year, once every 2 years, so you don't need to buy it again, and you buy what you can afford, which is predominantly the non-discretionary items, those consumer staples that you need. So we expect discretionary spending to be much more constrained over the holiday period. And so retailers that have a bigger percentage of their sales during the holiday period and those that are discretionary in nature are likely to see the most pressure. Home Depot, their holiday sales period is actually in the spring, so they're not quite the prime example. But when you think about retailers like Best Buy, there's a lot of exposure there.
There certainly is a lot of exposure. When you sort of look at kind of what gets categorized as discretionary, because I always feel like the lines get blurred. I mean, you can even take a lot of the things at Home Depot and say, you know, for a lot of people, those are staples, right? I mean, you may not need them every year, but they're still staples that you have to have in your home here. With something like a Best Buy, somebody could actually make the case that there are certain electronics that Best Buy traffics in, whether it's computers or printers or TVs, that for a lot of people are also necessities as well.
Yeah, for some of those products, the answer is yes. Those are necessities, and when products break, you need to replace them. There is a replacement cycle that's likely to accelerate in the next 2 years in consumer electronics. And Best Buy in their last fiscal quarter talked about improving demand for TVs as well as laptops on a unit basis. So there are some signs of positivity there. But for most consumers, you're looking at discretionary purchases that are going to be under pressure. And we expect sales continue to be down for Best Buy in the fourth quarter and potentially lead them to guide their full year to the low end of the previously disclosed range.
When it comes to consumer spending and consumer spending on a lot of these hardline goods here, Seth, how much of the softness that we're seeing there is also because of some of the shift in spending to services, which seems to have been the trend not only for the last couple of years, but most people expect this holiday season, even amongst gifting, is probably going to be much more service-oriented than goods-oriented.
Yeah, that's led to even more pressure on goods and discretionary goods in particular. And we expect that trend to continue into 2024. That being said, I'm not sure we will see that mix of PCE, that services, revert all the way back to pre-pandemic levels. There's a reason to believe, because of the work from home change, that we'll see spending on goods, percentage of PCE, remain somewhat elevated relative to pre-pandemic.
Are you anticipating that we're going to see maybe some more promotional efforts and discounts out of some of these retailers in order to keep those sales levels up?
Undoubtedly. So this is going to be a promotional holiday season. I think we'll see the promotions ratchet up as we get closer to the conclusion of the season. It'll all depend on where the demand shakes out for Black Friday, which will dictate how much more promotional it gets in those last 3 weeks before Christmas.
All right, Seth, great to catch up with you. Seth Basham there over at Wedbush. A closer look here at some of the hardline retailers on the heels of those Home Depot earnings that we got earlier this morning. Tomorrow morning, of course, we get quite a few other names, including Target and TJX. All right, we're going to go back down to Washington right now, where we're learning that the House of Representatives has started a floor vote here on a stopgap funding measure here that would at least plug the budget gap for the next couple of months until something more permanent can be decided on. Kayleigh Lyons is joining us right now down in D.C. for more on what's happening and what is happening right now. Kayleigh, where do we stand?
Well, a vote is happening right now, Romaine. This is actually on an amendment to one of the appropriations bills, the 2024 Labor, HHS, and Education spending bill. So this vote has about 7 minutes left. There will be 2 more 9-minute votes, and then they will be voting on that continuing resolution, this 2-part stopgap measure, laddered, if you will call it, a continuing resolution that will continue to keep the government funded beyond the deadline of Friday. It is assumed that this is looking like it's going to pass the House after Democratic leaders express support for it, but we're not quite at that vote, Romaine. You can expect it to begin roughly in 30 minutes or so time. So make sure to tune in to Balance of Power for the latest.
We certainly will. And 2 big issues, though, Kayleigh, and I'm wondering if you can just answer this for us, is the Freedom Caucus had put out a statement earlier in the day saying that they were actually opposed to it. That's, of course, a faction of the Republican Party, the same faction of the Republican Party that effectively nudged McCarthy out for making a compromise on that last budget bill.
Yeah, that's exactly right, Romaine. What this continuing resolution does is keep spending levels steady. It does not have the kind of steep spending cuts that many of those conservatives in the House Freedom Caucus have been looking for, which is why many of them have signaled that they will not support this measure. Will they, though, take the same kind of extreme steps in trying to oust Speaker Mike Johnson? The suggestion seems to be that not this time, that at least they can trust him, according to one member, which they didn't necessarily have with the former Speaker Kevin McCarthy. But it does speak to, Romaine, the real difficulty of keeping this Republican conference together if you're the Republican Speaker, because even if this continuing resolution can pass, it just punts this whole spending debate in terms of actual appropriations bills and a budget to January and February. He's still going to have to reconcile the desires of many of that ultra-right flank of his party with something that can pass in a Democratic-controlled Senate and be signed by a Democratic president. Yeah. It's a very, very tricky job. And in theory, just passing the CR is almost the easy part.
Yeah, a tricky job, but kicking it to January, February, and we should point out, kicking it into what is effectively a primary election season where a lot of decisions get made, not necessarily in the best interest of the country, but in the best interest of those folks looking to get a job in Congress. Kayleigh, great to catch up with you. Stick around. She'll be back here at the top of the hour as co-host of Balance of Power. I'll be back in a second right after the break here to set you up for what investors are going to have their eye on tomorrow. This is Bloomberg. Here on this November 14th, the Tuesday afternoon, we saw one of the best days for U.S. financial markets all year long. That was predicated, of course, on a big event this morning, that CPI report. We're going to get a lot of big events tomorrow. Investors keeping their eye on what's going on down in Washington, where the House of Representatives is set to vote on an interim funding plan to keep the government going at least potentially through February, but then at some point they would have to reconcile that and find some sort of longer-term plan. If that deal is struck before that November 17th deadline, maybe providing a little bit more relief for this market. Tomorrow, all focus is going to be on Xi Jinping and President Joe Biden, the 2 leaders of the 2 largest economies, set to meet face-to-face for the first time in about a year on the sidelines of the APEC summit going on over there in San Francisco. And the backdrop for that summit in San Francisco, at least for China, is a big slew of data set to come out overnight here. That includes its MLF rate, industrial production, as well as retail sales figure and fixed assets for the world's 2nd largest economy, an economy that has been on the ropes now all year long. Meanwhile, back here in the U.S., the upside, the positive surprise, I should say, that we got on CPI, a lot of questions as to whether we're going to see a repeat of that when we get the producer price index, which comes out tomorrow at 8:30 a.m. Washington time. At the same time as PPI drops, we're also going to get retail sales. Retail sales numbers, at least on a headline basis, economists actually expect to contract. Whether we get another positive surprise and help sustain this rally remains to be seen, but earnings are going to be a big part of that as well, and we get quite a few of them tomorrow as well. Target, TJX, Cisco, Palo Alto, and Tencent, just some of the names scheduled to report. I'll be back tomorrow with full coverage. Balance of Power is up next.